New York City on this Wednesday, December 18th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills this morning. Let's get to the three things that you need to know today.
First up, U.S. stock futures steady as the Federal Reserve is all but set to cut interest rates today. The central bank will announce its final policy decision of the year at 2 p.m. Eastern Time and unveil its summary of economic projections. That'll offer us insight into the central bank's rate path going forward. Now, some investors expect the central bank to signal fewer cuts to come next year than previously projected. Bond traders not so sure. They've been boosting wagers that the Fed is about to signal deeper cuts than the market is currently pricing in.
Plus, the Dow Jones Industrial Average seeing its longest losing streak since 1978 this week. The index seeing its worst stretch of losses in 46 years after closing lower for 9 consecutive sessions. More than two-thirds of the index's members have fallen since the beginning of December, which includes Nvidia, the world's second largest company, and United Health Group, which is down nearly 21% since the murder of executive Brian Thompson. The Dow's decline comes in stark contrast to the S&P 500 and the Nasdaq 100, which have been trading near all-time highs.
And Nissan and Honda, merger between the two are on. The Japanese automakers confirming reports that they are in talks to merge, which would create the world's third largest automaker, helping both of them navigate a tough macro backdrop for the auto space. Nissan shares jumped by the most on record following that report. Nissan's troubles had exploded into headlines early in November when the company slashed its profit forecast and said it would have to cut 9,000 jobs globally.
We're hours away from the Federal Reserve's final rate decision for 2024. That's due at 2 p.m. Eastern Time today. We'll also get an updated dot plot to provide further clarity on how Fed officials are thinking of their policy path into next year. Here with what to expect, we've got Yahoo Finance Fed correspondent Jennifer Schonberger. Hey, Jennifer.
Hey, Brad, good morning. Indeed, let's do it. The Federal Reserve widely expected to cut its key interest rate by a quarter percentage point this afternoon before tapping the brakes and likely signaling a more cautious approach to cutting interest rates next year. A 25 basis point rate cut on the Fed's benchmark interest rate would bring it down to a range of 4.25% to 4.5%. The rate cut comes in the wake of strong economic data, stickier inflation, and a job market that's proven stronger than thought, though still showing signs of cooling. At the same time, President-elect Donald Trump's forthcoming policies, from tariffs to tax cuts, hold economic implications for Fed policymakers to navigate in the new year. That backdrop has prompted some to question why the Fed would even cut rates today. The economic picture is expected to tee off a more cautious Fed with guidance for a slower pace of rate cuts and the prospect of fewer rate cuts forecast for next year than previously thought in September. Fed Chair Jay Powell has already opened the door for the Fed to adopt a slower pace if needed, saying in early December that, quote, "We can afford to be a little more cautious because the economy is stronger than expected earlier in the fall." The current median projection is for 4 rate cuts next year, but some economists see that being scaled back. Goldman Sachs, Deutsche Bank, and JP Morgan all see 3 cuts next year, but Morgan Stanley and Wilmington Trust see the Fed retaining the estimate for 4 cuts next year. That decision coming down at 2 p.m. Eastern, followed by a press conference with Fed Chair Powell at 2:30. Back to you.
All right, Jennifer, thank you so much as always. And Yahoo Finance is going to have coverage of the Fed's rate decision, the last of the year, starting right here at 2 p.m. Eastern. After that decision, we will get former Fed President Loretta Mester's reaction. And tomorrow we will also hear from former St. Louis Fed President Jim Bullard as well. Then on Friday, San Francisco Fed President Mary Daly joining us for a live episode of Opening Bid at 10 a.m. Eastern. If you want Fed speak, come to Yahoo Finance for all of those voices. Now, in the Federal Reserve's latest summary of economic projections, our next guest expecting an across-the-board hawkish shift from policymakers. Joining us now in studio, we've got Francis Donald, RBC chief economist. Francis, great to have you here with us. So today it's a cut. It's going to be the cut. It's about what's next and what we'll see in that SEP. What are you expecting?
Well, it's just a mark to market. Growth has been better. The unemployment rate has not fallen as much as expected, and inflation is stickier. Most measures of the Fed's preferred inflation is really floating around 3%. That's just not a condition, a set of conditions that's going to allow for a proper easing cycle, even if that's what the Fed wants. So the core today is really, where are their personal biases? We don't love that as economists. We want hard numbers, but the devil will be in the details of Powell's presser and how he talks about how the Federal Reserve is thinking about an enormous set of possibilities and extraordinary uncertainty over the course of 2025.
What are the key words that we could hear from Fed Chair Powell that would really express caution as it is talked about and discussed among the FOMC members here? Because that was the theme that our own Jennifer Schonberger teed up and told us to anticipate going into this.
Fed poetry, this is my favorite topic. What are the words the market will be looking for? Careful is a word that we heard a lot whenever we see an inflection point. So last time the Fed used a lot of the word careful, it meant an end to the hiking. We could be hearing words like pause. Pause would mean a breather. So maybe we cut and then we assess. I'm not sure that we'll hear a straight up confession to hold or prolonged holds, but those are words that we're looking for as well. To be honest, what I'm looking for a lot more is not just the indication around the pause, but how are they thinking about tariffs? Tariffs are really complicated for central banks. They increase prices, but they also produce growth shocks, which is ultimately disinflationary or can move up that unemployment rate. How are they considering that? How are they thinking through the uncertainty around data? We just had a large election that's skewing a lot of our confidence data now to the upside. That's making it more difficult to get a clear read. So I want to hear more about their perspectives on some of these issues that'll inform the next year. Then I'll be too focused on individual words. I got to tell you too, this is a Federal Reserve that 1 month is telling us this is their preferred indicator and the next one tells us another one. So of course markets will react to words like pause and careful, but pay attention to the longer term perspective and their frameworks a little bit more.
It's hard to suss out what they're going to do next when they are so data dependent, but the data is really murky, to your point, Francis. How does that play into your call that we can expect another cut to come in January? Because you lay out a scenario where inflation is still sticky. What is the justification going to be?
Well, it's essentially that this is a Federal Reserve that has told us, they've been very clear, they don't want rates to be as restrictive as they are now. Even though the unemployment rate has not weakened as much as many expected, it is still weakening. And Chair Powell has said, we don't need more weakening in the labor market. So this is a Fed that said, we want to get closer to their estimate of neutral. Now, this might be the most interesting thing that we can look at today is what is the Fed's estimate of neutral, because that is their anchor for how far they're trying to get. In the past, or the last meeting, they said they think it's around 3%. We're an awfully far away from 3%. But do they now indicate it's 325 or 350? That'll tell us that they're actually trying to walk back what they're doing in 2025. So we're listening to them. We're trying to take them a little bit at their word that they want to get closer there. But am I putting big bets on January? No, it's just a reasonable base case. Today will be an important meeting as to how we should think about the January and March meetings.
As we're thinking out to 2025, how much will getting to their 2% inflation target actually move that SEP and the ultimate rate that they're all setting as their either neutral rate or where we could see the overall kind of positioning in the cut policy start to terminate as well?
Well, you're getting to the core of the existential crisis that economists and central banks are having, which is, can we even get back to 2%? And more problematically, what if the inflation that's keeping us above 2% is supply side, driven by things like tariff shocks or geopolitical conflicts? The Fed can cut or hike interest rates all at once. It's not going to change the amount of tariffs that are imposed on some of these trading partners for the United States. So the Fed may have to say, you know what, we can't risk the unemployment rate rising just to get back to 2%. If we stay around 2.3%, that might be enough. So I'd love to hear more from the Federal Reserve. I don't think we will today, but if I had a Christmas wish list, it would be, Federal Reserve, tell us how you're thinking about the shifting nature of inflation and whether you're actually going to cut, even if inflation is coming from non-demand sources or non-interest rate sources. That's really what I'd love to hear from the Fed. I probably won't.
Well, what do you think is more likely then? A Fed that admits that they're going to take policy into account, or a Fed that backs off from the 2% target?
They will tell us, like all central banks are telling us everywhere, we can't make decisions on things we don't know yet. And the scope of things that they don't know is phenomenally large. There are a lot of things that are very pro-growth that could be coming through. Deregulation, for example, tax cuts, but those come first or after we see trade shocks that could actually do the opposite, be growth negative and lift the unemployment rate. So the sequence of events is something that we don't know. We don't know the magnitude of it. So they have to go with a generalized base case. What we'll probably hear is, and Chair Powell told us in 2018, he used this example in New York City. He said, when you're in a room with lots of furniture and the lights go out, you move more slowly. That's his mentality. And I think maybe we'll come up with another more poetic metaphor today for needing to be more careful, to use a word we talked about, in an environment with extraordinary uncertainty.
Francis, we only got 30 seconds left here. I know you're an economist, but if you were to put your market strategist hat on for a hot second, and I know the rest of your team evaluates what the market would do and how they're pricing in any type of hawkish outcome from the Fed here, what is the outlook there?
Well, this is a market that's already moved very closely towards our view that the Fed would not be cutting as much. So even though we expect a hawkish outcome, remember what is priced. What we expect to happen is already priced. So even though we're on the hawkish end, we say there is scope today for some dovish little comments. Now, Powell's going to want to maintain some optionality. He doesn't want that bond market to tighten before he indicates it's time to do that. So I wouldn't be surprised, even if we see that neutral rate come up, even if we see the Fed saying it might be 3 cuts, not 4 cuts next year, that he tries to keep the door open, sprinkles in some dovishness along the way.
All right, 'tis the season for some turtle doves here. Francis, thanks so much for taking the time.
Thanks for having me.
Appreciate it. The Dow Jones Industrial Average is seeing its longest losing streak since 1978 after closing lower for 9 consecutive trading sessions. The losing streak comes as the S&P 500 and the Nasdaq 100 sit at record highs. Investors going all in on the Mag 7 names, those magnificent sevens. And joining us now for more, we've got Ross Mayfield, Baird investment strategist. Ross, great to catch up with you. Good to see you here. First and foremost, what do you just make of the concentration here that is certainly playing out in the markets right now as long Mag 7 seems to be one of the most crowded trades?
Yeah, it's certainly something we keep an eye on, but I would say that if you had been worried about that concentration or used it as a reason to get out of the market at any point over the last couple of years, it would have been a mistake. I think that we hand-wring over this too much. I think that instead we should be celebrating that some of the biggest and most innovative companies are in our markets. Concentration risk or heavy concentration has not been a good forward indicator over the last 40 or 50 years based on the data that we've seen. So it's something to keep an eye on. It maybe makes the market a little bit more fragile to something like Nvidia having a bad stretch run, but it's not something that we worry about too much.
Well, then what do you worry about when it comes to the Mag 7? Because they've obviously had a record-breaking year to date. I think the latest I checked up over 75% year to date here. Is that going to be the case for 2025, regardless of the macro environment in terms of what the Fed may be doing?
Yeah, look, I mean, these names have largely proven somewhat insensitive to rate moves, unlike other growthy names. I mean, most of them are very cash rich and low debt. They have big wide moats, and they're trading on secular themes, not the more cyclical nature of interest rates or, the economy over the next 12 months. I think the biggest question for 2025 about these names is, all right, we know the story. They've spent aggressively billions and billions building up the infrastructure to support this new AI world that we're entering. I think the thing that investors are going to want to start to see is some ROI on that investment, right? These have traditionally not been big CapEx names, and they are now. So there's a lot of dollars going into the ground, into real things. And I think we're going to want to see whether it's the killer AI app or the big step forward in productivity or business leaders coming out and saying, this is how we're integrating this into our businesses today.
Right.
We haven't quite seen that yet. So that's going to be big for 2025.
And real quick, Ross, last week we heard Microsoft talking about how the chip shortage has come to an end. And this morning I was taking a look and you can see GPUs popping up on eBay. That seems like a bearish signal for chip stocks moving forward. What is your thought specifically on what chip demand could do to some of these AI names?
Yeah, it's a great question. The chip stocks and the semis tend to be a lot more cyclical between supply and demand. I would still be interested in owning them in 2025 with the idea that there could be a lot of volatility. This is a secular theme, right? AI is a big long-term theme. So you need to be able to ride the ups and downs. I would still want to be owning these, not just in 2025, but for the rest of the decade as well.
Ross, as you think about more broadly some of the themes that you were mentioning, and it's remarkable right now, thinking about what the application is that could actually be the game and the kind of ground shifter here as you think about what businesses would leverage versus what household consumers would say is our go-to AI app. And there will be several ones, but as we kind of think about the stack and the applications that sit on top of the models, that sit on top of the chips, who is best positioning themselves right now for the killer app, perhaps, that could come about and ultimately be able to add on to an existing install base that's already out in the market?
Yeah, it's the right question to ask. Unfortunately, it's a very tricky one. I mean, you start by looking at the companies building the infrastructure, the hyperscalers. I mean, they have the capital and they'll have the infrastructure underneath to kind of be able to be first movers. They have pretty vertically integrated, kind of supply chains up and down what they do. So I think that those companies are well positioned. The less satisfying answer is that company might not exist yet, or it might be an early stage venture company. I mean, when you think about what mobile internet did, the companies that really capitalized, say like an Uber, didn't exist before we had these kind of the stack built up, to use your framing. So I think that a lot of those companies that end up building the killer apps, whether it's consumer facing or B2B, might not even exist yet, or they might be being built out in some garage somewhere. There will be a lot of opportunity once the infrastructure is built, because again, it's billions and billions of investment. There's only a couple of companies that can do that. But once that's available to developers and coders out there, there's going to be a million opportunities for smaller companies to take some share.
All right, Ross, thanks so much for joining us.
Thank you.
Coming up on Morning Brief, we count you down to the opening bell on Wall Street ahead of that key Fed meeting. Plus, we'll break down the latest in merger talks between Honda and Nissan. And we'll get a check-in on shares of Tesla. Is the EV maker falling to the downside? Should you buy the dip? We'll discuss that and much more ahead on Morning Brief.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up here, we got to talk about Honda and Nissan exploring a possible merger that would create the world's third largest automaker. Yahoo Finance's Pras Subramanian joins us now with more on what it could mean for the industry here. Pras, what do we know so far?
You know, these two big names, the auto world, I saw this headline and it sort of shocked me. It's such a big deal.
Eye-popping.
Eye-popping, yeah. But I'm not surprised by this, given the fact that where both these automakers sit. You know, Nissan struggling here and in the U.S. Once known for these performance enthusiast cars, now they're sort of known for cheaper economy cars, so they're struggling. Honda, sterling reputation, great brand, but they can't really. They don't have the scale to take on Toyota, right? So this is a way for them to actually take on that major player in the auto space, Toyota. You get that scale, you get the shared development costs, which are so high in this day and age, in particular because of EVs. It gives them the ability to compete, and it sort of makes the numbers work from an automotive sense. Now there's drawbacks, of course, with mergers, but this on the face of it could be a good idea for both of these companies.
Are you surprised at all by the degree of the stock pop, given that it's obviously not a sure thing yet? And we're going to be talking with regulatory experts later in our programming specifically about this, but was just curious your reaction to the street sort of pricing in the inevitability of this deal.
Yeah, I mean, well, last night Nissan put out a press release saying that we're not talking, but we're not saying we're not talking. You know, essentially saying that. So it's basically happening. Yeah. You can see that the Nissan stock is rocketing higher because it's such a huge move for them. They are really struggling. I kind of see them almost as our Stellantis. You know, they're struggling with their brands. They're a big name, but they need to sort of get the formula right, and this is a way to do that with Honda's reputation and their manufacturing capabilities.
What does it say about how much more cost synergies Nissan needs to bring into their operation? They already have the partnership, long-standing alliance since the late 90s with Renault, Nissan, Mitsubishi, and that's been extended out to 2030, I believe, already as of last year. So how much more do they need to shrink costs, even just to put more product into the market at this point?
You know, that Renault-Nissan alliance has been a very strained relationship for many years, and they may not have been optimizing that in terms of a cost sharing and platform sharing point of view. This sounds like it'd be a more a beneficial relationship. In Japan, they have the koretsu, which is basically these relationships where these big companies have informal partnerships. They work together as suppliers and they help each other out. It's part of the way things are done in Japan, apparently. And so this would be more of a cementing of that relationship, even beyond just the koretsu relationship. So I think that's why there's a lot of a lot of enthusiasm for this merger.
Yeah, certainly a lot of it.
Possible merger,
and we will definitely continue to cover it as we get more details about the inevitability or possibility level of that merger to come. Pras, thank you so much as always. Appreciate it. Another trending ticker we are watching today, Tesla's Shanghai plant manager, Song Gong, has left the company. That's according to a letter sent to staff. Now, Song had overseen the construction and then became the manager of the company's Shanghai factory back in 2018. And this is Tesla's largest plant in terms of output and exports to both Europe and Southeast Asia. And this is really interesting because not only did this individual have a strong impact on that Shanghai plant, but he also helped troubleshoot issues in car maker locations outside of APAC. He was sent to California and Texas back in 2022 when there were some challenges with those factories. But the Shanghai mega factory, it's Tesla's first energy storage facility outside of the U.S. It's the company's second major investment in China in the decade since entering the region. So certainly a massive part of the business and perhaps one of the reasons that we're seeing Tesla take a little bit off the top in the trade today.
Yeah, Shanghai Gigafactory is essentially the Eastern Hemisphere mitochondria for Tesla and their operations, and being able to service parts of the world that they're trying to take on even more of market share from. The problem that they've run into is especially two-pronged here. One, the consumer. The consumer in China that's been looking towards vehicles has even more of a nationalistic mindset now. And then the other prong here is that even with that consumer mindset, the mind share shift also even more direly moves in the direction of some of their competitors, because you have incentives that are also put forward by the government in that region to make sure that there are boosted sales of some of those homegrown entities as well. So two-pronged hit. However, for Shanghai, Giga Shanghai, they've really been able to make waves in just being able to have some of their mass market vehicles be received by the region, be produced there as well. And that's really kind of set up the tent pole for them in that operation situation in that part of the world. But more broadly here, it'll be interesting to see if there's any more reasons provided as to why this person Song decided to depart Tesla. It's a little scarce on details right now.
Yeah, and he'd been there since 2018, so a long time to last at a company.
I mean,
like Tesla.
essentially the entire time that Giga Shanghai has been in operation.
Right.
Yeah. So
time to move on.
Absolutely. We'll be continuing to watch shares of TSLA. Finally here, let's take a look at home builders. The Census Bureau releasing housing starts and building permits for November. Housing starts lower by 1.8% month over month. That is the lowest level since July. Still, single-family housing starts were up 6.4% from the month before. Meanwhile, building permits, they increased 6.1% month over month, but still slightly lower than November of last year. We'll be watching home builder Lennar today. They're set to report after the closing bell. There you're taking a look at some of the home builders here on your screen, and pre-market at least for some of the moves. There's really only one laggard, D.R. Horton right now. However, Lennar going into their prints later on today. It seems like they've got some fractional gains just before the opening bell here.
It's fascinating to take a look at the impact of some of this economic data. We did see the 2s, 10s curve steepening a little bit off the back of this. Just a sign of the importance of every single economic data point as well, especially as we are ahead of that key final Fed meeting of the year here. But on housing, it's been interesting seeing the broader industry outlook getting a little bit darker over the past few months over a couple of things. Obviously, macro headwinds impacting those housing starts, headline number decreasing 1.8%. You've also got inventory of new homes moving to the downside here, but you've also got potential policy implications, immigration moving forward. That could be a headwind to the industry as well. So certainly a lot of factors to take a look at. Right now, you're looking at a couple of home builders' stock performance year to date on your screen.
You know, just one quick note as well on this too, especially as we think about the totality of the housing market. Redfin actually just publishing this morning that existing home sales, so on the other side of those new home sales and building permits, of course, existing home sales actually rose to the highest level in over a year and a half in this most recent print for the month in November here. Now, you combine that with what we're seeing on the mortgage rate side, and of course, we'll get more of an update from Freddie Mac on the back end of this week, latter end, as we usually do here. What they had said, their chief economist last week, was that the combination of mortgage rate declines, firm consumer income growth, and a bullish stock market have increased home buyer demand in recent weeks, at least here. Outlook for the housing market improving. The improvement is limited, though, given that home buyers continue to face stiff affordability headwinds right now.
That's so important that it mentioned the stock market being a tailwind to home buying. The idea that market performance is giving people more money to spend, that's also putting pressure on inflation. It's just fascinating when markets in the economy talk to each other. I love when that happens. All right, we'll have all your markets action ahead right here on Yahoo Finance, so stick around for more. You are watching Morning Brief.
There you're taking a look at the opening bell at the New York Stock Exchange and at the NASDAQ. At the NASDAQ, you've got Ocean First Bank ringing the opening bell. Yeah, go ahead, press that button. And in today's game of Who Rang That Bell at the NYSE, you've got the Brazil Potash, I think that says. All right, well, we're going to confirm that in a hot second. But anyway, taking a look at the great folks on both sides ringing the opening bell there. We got some funfetti at the NASDAQ. And at the NYSE, got a lot of clapping and cheering. Okay, let's get to the markets here. Taking a look at the major averages, you got the Dow Jones Industrial Average starting the day flat, but to the upside here. We'll see if we can snap that losing streak. More on that in just a hot second. The NASDAQ Composite, you're seeing that flat, but to the upside. It's up by about 0.07%. Let's populate this chart for you. Why don't we? We'll give you a past 5-day view here where there are some fractional gains. The S&P 500, you're seeing that flat just barely to the downside to start off today's market activity. Lower by 0.03%. Since we're talking about the S&P 500, let's load up the sectors. 11 sectors. We've got them pulled up here on the screen so you don't have to go searching for them. Consumer discretionary right now, pulling up the caboose. We heard you want the bad news first, so that's down by about 0.9%. However, good news, XLK, technology sector for the S&P 500, you're seeing that up by about 0.25% to start off today. Looks like we're almost split here, but you've got more laggards than advancers as of right now. Also want to take a look at the NASDAQ 100 here and just put this on an equal view so you can get a good glimpse of where things are sitting on the heat map. It looks like we've got more decliners than advancers to start off today. Nvidia is your top advancer to begin today's market activity. That's up by about 2.3%. We'll see if we can see more of a continued bounce back in that in a hot second here. Pulling up the chart, just taking a look at the past 5 days just to give you a look at where things have pulled back. As of right now, past 5 days down by about 4.25%. If we were to put that on 10 days here, you'll see us still down by about 8%. A name that did move into correction earlier, and then ultimately now we're seeing if we can fight back just a little bit. And then additionally here, pulling up the boost to start off today, you've got Moderna. That's lower by about 4.5% here. Just want to briefly take a look at crypto. Of course, that's been in the lexicon, probably made it to your dinner tables or breakfast tables, whatever you're doing to eat at home. You're talking about Bitcoin, regardless of what you're eating, probably. Bitcoin right now sitting at about 104,000, sub 105,000, we'll call it. Past 4 days, or past 10 days rather, it's still up by about 5% and holding steady above 100,000 in totality. Okay, all that said, let's get to the big story that has been this week, and that has been the Dow. Let's get on over to Yahoo Finance's Jared Blickery for a look at the Dow Jones.
Thank you, Brad. My wardrobe twin this morning. Let's take a look at the streak that we have in play. Now, this is going on 9 days. It would be 10 days today. And if that happens, we have not seen this kind of a negative streak since the 1970s. You can see that we had 1978, 9 days of losses. I didn't see a 10, but we do have 11 days of losses going back to September of 1974, and then also October of 1971. And not shown here, I also have some additional dates. If we go to 12, it's 1968. And also 1941. So suffice to say, this doesn't happen very often. But what does it mean? I don't think streaks are particularly predictive of what goes on in the markets. In other words, what goes on tomorrow, not going to be determined by today's streaks because they're somewhat random. But I do believe in technicals and the power of the market. And let me show you what I'm seeing in the market here. You take a look over the last 10 days of the Dow versus the NASDAQ, two different markets, two different stories. And I was writing about this in the morning brief this morning. We see the Dow here we see the Dow here down about 3.37%, the NASDAQ up 1.82%, and then you look at the year-to-date, that's a pretty sizable difference. The NASDAQ has doubled the performance of the Dow, and a lot of that has changed recently. What is going on? If we take a look at the components, and this is what's happening today, I'm going to show you the month to date. This is pretty instructive. You see a lot of green, not in Nvidia, but to the left, you see the mega caps have asserted, and if you take a look at the NASDAQ, you really see that in spades, but there's a lot of red on the board. And if we sort by equal weighted performance, you can see there's a lot more red than green. And the worst off here is United Health. Healthcare stocks have not done well. I'm going to show you a year to date, and you can see how this just turned negative on the year relatively recently. And this is particularly notable because United Health, I believe, is the highest priced stock in the Dow, and the Dow weights stocks by price. It weights the index and all of its components by their price, not market cap. That's how the S&P 500 and the NASDAQ are calculated. And this accounts for some of the differences that we've been seeing here. So We had this great report come out by B of A. This is their global fund manager survey that they do each month. And for the month of December, they found that cash allocations were basically at a historical Rubicon, a very important threshold. There's been a lot of sucking of cash out of the market, deployed into equities. And with all this mad rush, it looks like there's a bit of front running going on with respect to next year's expected changes in the markets and expected change in leadership in the White House, with Donald Trump coming to the White House once again. So considering all of that, I would be more concerned about the record cash position and how that has dropped recently rather than a Dow losing streak. But very notable as this gets the discussion started here, Maddie.
Certainly, Jared. All right, thanks so much for joining us on the market moves after that opening bell rang. It's now time for today's strategy session. JP Morgan out with a new report saying the AI trade is going to shift a bit into its next phase for 2025. Joining us here on set with more, we've got our very own Josh Schaefer. And Josh, as you mentioned, this is a bit of a consensus call for 2025. The AI trade, it's not going away anytime soon, but it is going to shift slightly. What stands out to you in this note?
Yeah. So in this note, JP Morgan highlighting top picks is Amazon, Meta, Alphabet. And I think what stands out with that, Maddie, is there's sort of this shift to, Goldman Sachs has called this the shift from AI infrastructure stocks to AI-enabled revenue stocks, right? So who was building the infrastructure? We know the names, right? That's an Nvidia of the world. Those are the companies that are making chips. Of course, some of these hyperscalers we're talking about, Brad, also getting into the chip game a little bit, right? Yeah. But it's about who is actually talking about AI as a source of revenue. And Meta sticks out as this because I think Meta is an easy one for us to understand as consumers, right? How does Meta use AI? I use Instagram. You go on Instagram, you use Instagram Reels, and they're feeding you.
Are you using AI to make your Reels these days?
No, but they're feeding you AI ads, right? They're giving you targeted ads and new targeted content based on how you're using Reels, right? That's literal AI monetization that Meta has said is giving them more ad revenue per user. And so that's a simple way to think about how AI in the next phase, okay, I bought the chip. I'm starting to incorporate the chip in my company. How does it help me make more money? That's how Meta's using it. And what JPM is sort of pointing out here is what companies are going to be able to profit off of that use case of AI. And you think about some of these cloud services companies.
I'm just waiting for the day where you come in on a Monday and you tell me that you used AI from Instagram in order to make a reel about you making your Sunday chili. I can't wait for that, Josh. But all things considered, one of the things that Baird and Ross from Baird had talked to us about earlier this morning was really just focusing in on there has been no killer app just yet.
Sure.
And the larger question of, do you need an install base to get that killer app across, or do you just need to create something and it's perhaps something that's not even created yet? Because as of right now, the only thing that's at the household level lexicon is really ChatGPT at this juncture. Until something else comes along, and whether it's in a already built out experience or if it's something that's yet to be built, that's what really the monetization could be driven for.
Well, and you think about the other names that JP Morgan's highlighting here, right? So they're highlighting Amazon, Meta, Alphabet, and Spotify.
Yes.
You talk about a killer app. The concept of a killer app coming from an app that we all already use kind of makes sense to me, right? Yeah. So for Spotify to be able to utilize AI more in their experience and bring that more to what you're already listening to and using on that app sort of makes sense, rather than is it an app that we're not using that much from a company that doesn't quite consume our phones at the level that these companies do. Yeah. Sure, I could see it, but it's a little bit harder to get there in my head at this point because it literally doesn't exist. So I think that part of sort of this trade makes sense to me is, okay, all of these companies already have a massive install base. Yes. If you can get a little bit more productive by using AI, and again, I think it's that pointed advertising, pointed content that you can get to people, because if you're giving Brad Smith, who loves to golf, a lot of golf ads, you're more likely to click through those and maybe buy something, right? So I'm more likely to advertise with you, and you eventually just make a little bit more money off that process.
And the reality is, if we're going down the splash mountain of even more deregulation, that there could perhaps be one of those major players that identifies what we had seen in Facebook acquiring Instagram, something analogous to that type of deal could come in this AI landscape as well, that could then just supercharge one of these larger.
We'll have to ask ChatGPT who's going to do that, Brad.
Yes, we will. Exactly. Josh, thanks so much. Appreciate it. All right, Maddie, on over to you.
All right, it is time now for our chart of the day. I wanted to take a look at one particular chart from that key Bank of America fund manager survey yesterday, because I think this is so telling about where the flows are heading here. Take a look at the most crowded trades on this chart behind me. Over 57% are long the Mag 7, and then you've got a couple of other trades here, long the US dollar, the Russell, and then of course shorting China equities. Look at that outperformance in terms of allocation to the Mag 7 here. Really telling as we head into next year, and we've been talking with guests throughout our show about what that Mag 7 trade will be based on next year. Valuations continue to be the zombie in the room that never comes. It's not been an issue previously. Why would it be an issue next year, especially when you've got JP Morgan saying AI CapEx is only going to go up from those hyperscalers that are all customers of one another. And then you've also got the fact that this is a trade that has continued to hold up against higher for longer rate environments, regardless of what the Fed does moving forward. We continue to see the Mag 7 as sort of your haven trade, and perhaps that's also why we're seeing the dollar up as well. Just this idea of finding safety in large caps and in U.S. exceptionalism, perhaps continuing as we head into 2025, Brad.
All right, excellent stuff there, Maddie. Coming up on the other side of this short break, we're taking a look at healthcare stocks after President-elect Trump takes aim at drug pricing middlemen. That's coming up.
We have a thing called the middleman, you know the middleman, right? The horrible middleman that makes more money, frankly, than the drug companies, and they don't do anything except they're a middleman. We're going to knock out the middleman. We're going to get drug costs down at levels that nobody has ever seen before.
That was President-elect Donald Trump saying his team plans to rein in the power of pharmacy benefit managers, so-called PBMs. Now, shares of Cigna, CVS, and United Health, owners of the largest PBMs, recovering today after all closing to the downside after those comments. For a look at what PBM reform could mean for the industry, I want to bring in Jared Holtz, Mizuho Healthcare equity strategist. Jared, great to have you on. So I want to start on these comments from President-elect Trump saying these middlemen are getting rich. How true is that, and how does the loss of these middlemen potentially impact consumer pricing moving forward?
So thanks so much for having me. You know, the comments are sort of true. I think it really just depends on, you know, the individual line items we're talking about, the specific drugs that are being targeted as those that are, you know, more expensive or more profitable. You know, the PBMs are creating some value. You know, they're helping patients kind of manage through the treatment paradigm with respect to which drugs to take, which formularies drugs are on, and kind of managing that whole process. So there is a benefit they are providing. I think some of it is just looking at the margin contribution and the profitability contribution at the PBM level, and also just the managed care level more broadly, and saying that, within the construct of the industry, there are so many players that are making tons of money in the middle here. We have to be cognizant of that. And it's a little bit akin to what Trump said in his first term or first administration. So some consistencies here. We've heard this before, but I think all in, there are definitely some truths to it.
How likely is this to be a bipartisan effort moving forward?
Seems very bipartisan. I think a lot of the healthcare topics that we've talked about over the past couple of years, including this one, including drug pricing, just trying to get this whole industry right-sized a little bit more, seems to be pretty bipartisan. I mean, even last week, we saw a couple senators, including Elizabeth Warren, talk about maybe stripping the PBMs or stripping part of the pharmacy business away from managed care because it was creating an unfair advantage for the insurance companies. So it seems like members of the Republican Party and Democratic Party are pretty aligned on it.
And Jared, I wonder from your perspective too, just the concept of middlemen and the impact it has on some of these companies like a CVS, like a United Health, for example. If we do see reform on PBMs under the Trump administration, do you think it's more likely that some of these names that have already struggled could potentially go into something like bankruptcy under the Trump administration?
I mean, bankruptcy is, obviously pretty hyperbolic. I mean, I would highly doubt it.
Fair enough. Yeah.
When it comes to, hopefully, I think when it comes to, some of the reforms that the government has kind of mentioned or would like to be put in place by 2028, which I believe is the timing for all of this, it really comes down to, some of the net pricing they're realizing, some of the pricing spreads that they get within certain plans in terms of what, they're getting from the pharmacy, what they're paying to some of these Medicaid plans. That's part of it. Some of the administrative costs, I think, are going to be significant, but probably are manageable. I mean, a lot of it is going to depend on whether the healthcare companies themselves, these insurance companies, probably right-size their business a little bit, rationalize, probably make some cuts. I mean, these are companies with thousands of employees. There are probably ways to offset this to some degree. And then the other thing to keep in mind is that we've been in one of the most pronounced utilization environments in recent memory with respect to medical trends, with respect to procedure volumes. That's all been fairly negative for United, Cigna, CVS, Humana, et cetera. If that starts to go the other way, which I believe it will at some point, just we've never seen this type of traffic at the hospital level, at least in recent memory. If that goes the other way, then I think that's a nice offset.
At the pharmacy level, if we did see more right sizing, does that mean more pharmacy deserts?
Well, the pharmacy business has been one of the most challenged in all of consumer retail for the better part of a decade. I mean, you saw, Rite Aid essentially go out of business. Walgreens has been trading like a distressed asset for 3 to 4 years now. I mean, there's some rumors that a buyout could happen. But if that were to happen, I think all you would see as a result would be many more stores cut. And I think you'll see the same at CVS. I mean, we're just in a different era as far as how customers or consumers are getting not only their prescription drugs, but how they're getting anything in the front end of the store with respect to, food and household items. So I think all of that is a struggle. It will remain one. But the stocks, I think, are already trading at fairly low levels. CVS 7 times, Walgreens around 5 times. So you're already seeing that distressed equity creep in here.
Jared, we got to leave things there on the day. Thanks so much for taking the time. We'll check back in the future too.
Great, thank you.
President Biden endorsing a potential ban on congressional stock trading. The president saying in an interview with left-leaning advocacy group A More Perfect Union, quote, "Nobody in the Congress should be able to make money in the stock market while they're in Congress." Here with more, we've got Yahoo Finance's own Ben Werschel. Ben, what would a ban look like and what are some of the potential hurdles?
Sure, I'll take the hurdles first because there's a lot of hurdles that remain on it. As you mentioned there, this is an entry by Biden here into an issue that he's frankly avoided for 4 years, for almost his entire term. His aides would often say, this is a question for lawmakers. The White House doesn't want to get involved. So it's sort of notable he's doing it, but it's a very kind of last minute entry here too. And this comes after 4 years of efforts on Capitol Hill. There's a bill in the House that has 79 co-sponsors that gets reintroduced every year and kind of never quite makes it to the finish line. It's going to happen again next year, so we'll see there. So it's the issues behind it. To get to the other part of your question of what it actually looks like are part of the reason for why this is such a trickier issue than you might think, because the summary of a lot of these efforts is a ban on lawmakers trading stocks, their spouses, and their dependent children. So basically their immediate family, banning it. But there's issues with that. If you own a family farm that's an S corp that could be considered an investment, do you have to sell that? That's one thing that the people that draft this have been struggling with. And then the other issue is how wide to make it. There's another bill that would include the president and the vice president. That gets it more controversial. There was another bill to do the Supreme Court to bring them in under this. That sort of blew up the effort a couple years ago. So it's a more complicated issue than you think, than that kind of quick summary of it. And it's also the kind of issue of lawmakers, whether they're actually ever going to police themselves, for sure.
Well, Ben, I think you summarized it perfectly, and it is such an important issue because lawmakers do make a lot of money off of the stock market. This is something that Nancy Pelosi and her husband have received significant criticism for. And I'm curious, in your reporting, if the timing of this has come up with any of your sources, because I've wondered to what extent this move from Biden at the 11th hour could be in direct response to the moves we saw from Pelosi that sort of ended his chances at a second term in the White House. Have you heard anything about this as a sort of tit-for-tat move in response to Pelosi?
I'm not sure about it back and forth with Pelosi. I think there's a definite sense that this is, an 11th hour move that if he'd done a year ago, might have been much more significant than doing it now. Congress is literally trying to get their last bill of the year. Yesterday, they unveiled it to get it into law by Friday so they can get out of here for the holidays. So it's definitely seen as like a kind of symbolic move more than anything else. There is a mood amongst some of the activist types I keep in touch with of kind of happiness that he's saying it, but definitely tempered by the political reality here too, and sort of questions about what Trump would be, because he's sort of sent mixed signals on this issue as well.
Right, and it's a fascinating issue that continues to come up but continues to go nowhere. It's kind of tough to vote against your ability to invest in the stock market. It's a great way to retire, as we cover all the time here at Yahoo Finance. Ben, thank you as always. Really appreciate it. Coming up, we'll take a look at some of the top trending tickers on Yahoo Finance in 30 seconds each. That is coming up next when Morning Brief comes back.
We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, Boeing resuming production of multiple aircraft programs, including the 767 and the 777. Earlier this month, production had resumed on the 737 MAX jets, and this comes after factories in the Pacific Northwest closed during a more than 7-week strike. The head of Boeing's commercial airplane division writing on LinkedIn that they have, quote, taken time to ensure all manufacturing teammates are current on training and certifications while positioning inventory at the optimal levels for smooth production, end quote.
Plus, Birkenstock seen its sales grow 22% in the fourth quarter, beating estimates on Wall Street. The company citing continued strong and growing consumer demand for its products. Closed-toe revenue growth was double the group average, and the segment now making up about a third of Birkenstock's business, despite the usual success of the open-toed shoes.
I got a couple of those. All right, finally, General Mills cutting its profit outlook for fiscal 2025, now seeing adjusted earnings per share to range from a decline of 1% to 3% compared to prior guidance of a 1% decline to a 1% increase there. So the company citing promotional investment or price reductions to spur demand as a reason for the reduced outlook here. Shares moving lower for GIS right now by about 2.5%.
All right, well, that does it for the morning brief. You can join me in the next hour for more analysis on catalysts, and then stick around for Wealth in the 11 a.m. hour, where Brad Smith will give you all the personal finance news that you need to know. Thanks. Welcome to Catalyst. I'm Madison Mills. Shauna Smith is out today. We are 30 minutes into the U.S. trading day, so let's get to the 3 catalysts that we are watching this hour. First up, we'll break down the market technicals to watch as Nvidia rebounds into the green, while the Dow faces its longest losing streak since the 70s. Plus, we'll look at antitrust hurdles facing Nissan and Honda as the two companies look to form the 3rd largest automaker in the world. And award season continues. The Yahoo Finance Award today going to the product of the year. We'll bring you full coverage on that product that may change your portfolio and the world next. Let's take a look at some market headlines to start off the hour, sponsored by Tasty Trade. First, let's pull up those major averages. A mixed picture here. You've got the Dow moving back to the upside after that longest losing streak here. The S&P still under pressure this morning, just below the flat line. And you've also got the NASDAQ just hovering around the flat line as well, as we are seeing a little bit of a mixed picture in that Mag 7 trade. But let's flip it over to the bond market. It's been interesting to watch the reaction that we have seen. A bit of a steepener on the 2s, 10s curve in particular here, but you can see yields moving to the upside here in the longer end of that curve. And finally, I want to take a look at our market darling here, Bitcoin, actually moving to the downside today, down just nearly 4% here, coming off of its highs from the week. Of course, we will continue to monitor the moves in Bitcoin throughout our programming today. Let's turn now to Nvidia, snapping its recent losing streak. If we're taking a look at shares of Nvidia for today, they do continue to move to the upside. Now, shares of the chip maker did fall into correction territory on Wednesday, dropping by 12% from its November highs. We're going to break down what was driving that sell-off and what's next for Nvidia. And for that, we've got Jay Woods. He's the Chief Global Strategist at Freedom Capital Markets. Jay, an honor to have you in studio with us today. Christmas comes early for me when we have you in studio. Talk to me about Nvidia. They entered correction territory. Yep. Now it's recovering. What are the technicals telling you about what's next?
Yeah, it seems a little toppy here. And this is not the end of the world for Nvidia, but it's under the microscope because compared to the other magnificent stocks, it's the only one down since November 1st. But Nvidia historically still up 130% for the year. Let's not forget that. But it has had 3 20% retracements just this year, 35% when you go back to the Japan yen carry trade. We're down about 16%. If it was to get back to its 200-day moving average, we're talking 24%. Technically still in a long-term uptrend, but near-term we're seeing what we call a head and shoulders top. We're watching that 130, 131 level carefully. It breached it yesterday. It's recapturing it today, but it has to recapture that 50-day moving average. But we saw this exact same thing play out last year, where it consolidated over the second half of the year before leading us higher. So while everyone's a little upset that it's not participating in the party with the other Magnificent Seven, and Broadcom broke out and leading it in the chip space right now, I'm not worried over a long term. In fact, I think it's setting up for another buying opportunity. If this head and shoulders top plays out, you want to back it out. Look at a weekly chart. It's been up above its 200-week moving average since January 13th, 2023. And if it pulls back, we're looking 110, 115 would be a great buying opportunity because the fundamental story hasn't changed. Nothing has changed there. And I think you're going to talk about it a little later on in the show. So to me, this is just a pause, but we're focused so much on it because, one, there's a little negative topping pattern that you have to be watching. And if it does break, your target is 110, 115, and that would probably be a great buying opportunity.
Well, you mentioned this idea that the market is a little bit toppy right now. How concerned should investors be about that, especially as we still expect to get the so-called Santa Claus rally coming up here heading into the new year?
Yeah, there's some toppiness to this because of the market breadth, meaning the advancers versus decliners. We've seen in the S&P 500, 80% of the stocks below their 10-day moving average. That is an oversold condition. Yeah. So what has happened during this oversold condition? We talk about the Dow being down 9 straight days, 9 times. Not since 1978. It's only down 3.78% during that run. It's been one stock that's been crushing us, UNH, down, it's 51% of this move over the last 12 days, 725 Dow points. So the move is just a garden variety sell-off, but the amount of stocks that are down is a little head scratching. But the positive side of this, the leadership is right. You have technology, communications, discretionary leading us. That's what led us on this bull run to begin with. They hurt us in 2022. They led us in 2023. We saw rotation. What are we seeing right now? We're seeing rotation. Some of it's within the Mag 7, Nvidia being the laggard, Broadcom joining this party, this new acronym with Batman or whatever you want to call it today. But to me, it's a little perplexing and gets me a little worried with the market breadth, but I think we're going to see that pick up and the rotation theme continue once we get through the end of the year and have that Santa Claus rally last 5 days of the year, first 2 trading days of 2025.
Let's talk about Batman for a second, because I'm curious if this is finally going to be the year where we stop constantly talking about the Mag 7. Are we going to get a new branding? No, why?
Well, it's just, these are the biggest stocks market cap wise, so we're going to pay attention to them. Broadcom is now one of the top 10 stocks, you know, and it put the B in Batman, and even though the symbol is AVGO. But yes, Broadcom, when you have $1 billion market cap, you're going to pay attention to it. The one stock in this group that no one's really talking about too much is Apple. Apple's at $3.8 trillion. It's the third biggest in the XLK now because they've repositioned that in July. And to me, that is a utility stock that just continues to climb. Its AI story is really just coming to our phones as every upgrade comes to our phone, and that upgrade cycle hasn't really kicked in yet. The potential on that upgrade cycle and the utility factor that it's been leads me to believe this could be a $5 trillion company by the end of 2025.
So more bullish Apple or Nvidia?
Well, I'm bullish both names, but right now Apple's breaking out, making all-time new highs. I think Nvidia has got a little room to possibly pull in and buy that dip. But I like both of those names going forward. Tesla's the one that always has me head scratching, up 100% since the election. Elon Musk keeps it very volatile. You never bet against him, but it's a stock you trade and you just hold on. But for the rest of those stocks, including Broadcom, it looks like what I believe the story will be, okay, where AI, we were focused on CapEx. Next year, we're going to focus on how does that CapEx go to work and where are the results. And I think Apple is starting to show us. Watch Rufus for Amazon. Google just announced a new chip. And then I know Salesforce is not in the Magnificent Seven or the Batman ETF, but it is a stock, you know, and software have been breaking out to new highs that used AI implementation with Agentforce. They just announced they're creating 2,000 new jobs because of Agentforce. That is AI implementation at its finest. So watch stocks like Salesforce that are finally putting AI to work, that are breaking out, making all-time new highs as we speak. So that's what I like.
That's what he likes. Well, final minute together. Something the market clearly doesn't like right now is the Dow. What can you tell us about what's going on there?
It's down 4%. It's not the biggest drawdown we've seen all year. We like big streaks. You know, 9 times sounds fantastic. But to me, the Dow, you know, it's a price-weighted index. It's 30 stocks. So just put it in perspective. When the biggest stock in that index, it's now Goldman Sachs, but it was UNH for a little while, you know, falls and causes 51% of the damage, you know it's one stock. And then ironically, the 2 new additions, Nvidia, Sherwin-Williams, they've been killing the Dow since they've been put in. I don't know what Intel and Dow Chemical have done. They're probably up. But so you have to know that when you're looking at the Dow, it's price weighted. But historically over time, they do trend together to the Dow and the S&P 500. The Dow is lagging the S&P by about 12% year to date. But I think there is a catch-up play. And if you look at UNH, that stock is very oversold, just got to a key support level. So if you want to dip your toe in the water, I know there's a lot of news in healthcare, and then that stock in particular with the CEO. This may be a good trading opportunity to buy a little bit of a rally here in UNH.
All right, Jay, interesting call there. Thank you so much as always. Really appreciate you joining us in studio. Our thanks to Jay Woods. Nvidia is looking to stay ahead of the competition with its next generation AI chips, making Blackwell Yahoo Finance's choice for product of the year. Yahoo Finance's executive editor Brian Sozzi is here with more on what makes the chip stand out as that top product choice. Hey, Sozzi.
Hey, Maddie. Yes, Product of the Year award going to Nvidia. Really, it was a hands-down favorite right out of the block with our editorial leadership team. It was going to Blackwell. 3 reasons why, and you can see a lot of those reasons here. One, based on all the reporting that we have done for this award, it became very clear that Blackwell is the leader. It is the clear leader in the AI chip race. Sure, you have AMD Intel's been trying to do something in chips, trying to get into the AI space, chip space, but it is Nvidia that still has its lead in large part because what is about to come with Blackwell. And then what is about to come, the interesting thing here with Blackwell, it has already developed a backlog of billions of dollars in related sales that Nvidia will start to drive home next year, really start to influence its top and bottom lines. And why it's generating those sales, of course, guys, is because they are the leading player in building out the AI infrastructure. You put all these things together, Maddie, and you really get the sense it was a Blackwell type of year, and it will be more of a Blackwell year next year as this chip gets in the hands of customers. And Maddie, you know, I will say this too. You made it in this business when you could stand next to a Blackwell chip on a big screen. That's how I know I made it. Good stuff. I can feel the power of this chip oozing off the screen.
I know you can, Sazi, and eventually we'll have some sort of like metaverse thing where you can really play around with that chip as you talk about it for Company of the Year. Thank you very much, Brian, for joining us on that. Yahoo Finance's Julie Hyman is also here with more on the power behind Blackwell. And Julie, I know you've done some amazing reporting on why this chip is so beloved.
Yeah, I mean, I will mention one of the ironies of this being picked as the product of the year. The thing didn't ship till the fourth quarter, right? But there has been such anticipation and such demand from the hyperscalers to get it to power their data centers and their large language models that's why we named it the product of the year. So if you look at some of the specs on this chip, and listen, I am not necessarily a semiconductor expert, but the numbers sort of tell the story here. So it has 208 billion transistors. That is more than 2.5 times that of Hopper, which was the predecessor chips. And then there's something that Nvidia talks a lot about, and other chip makers too, which is the so-called total cost of ownership. Blackwell is expensive. It is the most advanced and therefore the most expensive GPU on the market. However, Nvidia argues that because it is highly energy efficient, the total cost of ownership over the lifetime of the chip makes more sense. And then it's not just Blackwell that Nvidia is selling, it's really a whole computing system. So it combines with the Grace CPU for a full rack of computing power. That's what's going into these data centers. Now, CEO Jensen Huang, he rolled this out. He first introduced this in March. And here's what he said about Blackwell at the time.
There's no memory locality issues, no cache issues. It's just one giant chip. And so when we were told that Blackwell's ambitions were beyond the limits of physics, the engineer said, so what? And so this is what happened. And so this is the Blackwell chip.
So it's showing there the physical chip. It is the largest GPU ever made as well, we should mention. And it's made by using two die, basically two chips that are connected by a high bandwidth interface. That was one of the leaps, the innovation leaps that NVIDIA made in developing the chip. You can see what it's already done. Well, if you look at the revenue growth that we've seen for NVIDIA already, as I said, Blackwell didn't actually ship till the fourth quarter of the year. So a lot of this is demand for other data center chips like Hopper, what we've seen thus far. But the real surprise began for NVIDIA not this year, but last May when we had that big upside surprise in revenue. And then the company's revenue has just continued to grow here, although at a somewhat slower rate the bigger it has gotten, Maddie.
Yeah, that's certainly been a question we've been talking about, is the decline, or slowdown, I should say, in the profit growth estimates moving forward. Given that, and what we've heard this week from Broadcom, what are your sources telling you just about the path forward for NVIDIA and whether Blackwell will be enough to keep NVIDIA as the leader?
So let's be clear here. NVIDIA is still absolutely dominant in this space. When I talk to analysts, I talk to Ben Beheron, I talk to John Vin over at KeyBank, and they talk about 80% plus of the control that NVIDIA currently has on this data center generative AI LLM market, right? So they are hugely dominant. And when you look through the next year, Vin said, as long as they can solve some of their manufacturing bottlenecks that they have had and get the flywheel going, then they'll be fine. Yes, the revenue growth is expected to slow, but again, that's because they're coming from higher and higher numbers, and demand doesn't seem to be of a concern. The competitive threat is going to come from custom chips, most likely. AMD, yes, but Broadcom, as we've been increasingly talking about, got a lot of attention in its most recent report, talking about the increase in demand for custom chips. But again, when I talked to analysts, they said the custom chips aren't there yet. They are not yet competitive. They're going to chip away, they're going to increase, and at some point maybe they will be there. But if you look over the next year, doesn't seem like that is yet happening. You have to maybe look further out to see the changes that are perhaps going to come.
And perhaps those custom chips will be purchased by smaller customers who maybe aren't going to have as much purchasing power, which will keep Nvidia's lead at the top as well. 80% market share, you really can't.
Yeah, I mean, right now the hyperscalers are the ones who are spending the money.
Yeah.
They have big war chests, as we know, and they're very willing to spend. They feel like it is an imperative that they spend right now. So yes, to your point, when we get further along in the cycle and it's others spending, they're going to have perhaps different priorities. Keep in mind also, we are going to be switching from the training phase of AI more to the inference phase. In other words, right now, all those large language models are just sucking up information. Inference is when they put that information to work to actually think, if you will, to infer, to do the work that they are designed to do.
And you want the best chips to be able to do that.
You want the best chips. I mean, Jensen Huang has argued that NVIDIA's chips are the best chips for that. Some critics have said when we get to inference, maybe some of the other chips will also start to gain more market share because you don't need quite as much computing power when you get to that phase.
Right, okay, really interesting, Julie. Thank you so much, and amazing reporting as always. Thank you for bringing us the product of the year details that we need. Coming up here, we're gonna take a look at today's trending tickers. We'll get you the news behind those moves next, right here on Catalyst. Stick around. It's now time for some of today's trending tickers. You can scan that QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining us to break down these tickers today, I've got Josh Schaefer with me here on set. So first up, we're going to talk about Micron, set to report after the close today. Investors will be looking for an update on the chipmaker's AI memory business. As a reminder, this is a high bandwidth memory business that is the core to Micron's revenue story. Interesting note from Raymond James, they call their DRAM sales the best secular story that the industry has ever seen, just in terms of growth. But the question is that ramp moving forward and whether or not they'll be able to keep that growth into next year.
And I think also just importantly where sentiment's been at for this stock, right? You look over the last 6 months, stock's off about 20%, has rallied in the last month, Maddie. Seems like it's starting to pick up a little bit, but I thought it was interesting. Wedbush analysts pointed out in their note previewing the earnings, they said that they believe sentiment after going on a trip in Asia, they believe sentiment on memory was extremely negative, creating room for a potential sharp move upwards in the stock should Micron results and guidance roughly fit expectations. Essentially saying maybe meeting expectations in this case would actually be good enough for Micron to move the needle a little bit. Very rare to hear that, right? Yeah. That maybe sentiment has come down enough that just meeting and not necessarily raising could be good enough after the bell. But of course, Maddie, just the overall AI read-through here, right, is kind of the key story, I think, moving forward, especially given the price action that we've seen in a company that is, we'll call it related, related to Micron, right? Nvidia is down over 10% over the last month, getting a little bit of a pop today. But what does Micron say about the larger AI story, I think, is probably the big question for investors.
And it's been fascinating to see Micron be able to buck some of the seasonal trends that we've seen in terms of memory sales. And this is something that Bloomberg Intelligence talked a lot about, that they have been able to sort of withstand some of those seasonal headwinds. But again, will they be able to continue that moving forward? And how will the market price that in is certainly going to be something that I know we'll all be watching heading into that.
It's all 2025 guidance, Maddie. What's going on in the second half of 2025? Let us know, and then we'll see where it lies.
And then we'll have the Santa rally, and it'll all be fine. All right, well, let's move on to Nvidia. A report from the information detailing how Nvidia could build a cloud business that would rival the likes of Amazon Web Services. The chipmaker says it could generate $150 billion in revenue from software and cloud services in the long run. CEO Jensen Huang has said that cloud and AI software will be a very significant business over time. And the company is on pace to generate $2 billion annually from selling just software. If they did expand into the cloud business, that could be a huge headwind for Amazon, which has been the cloud giant in the room for so many years here. I believe Amazon Web Services makes up nearly 20% of Amazon's overall revenue, and a significant portion of that is in the cloud. They've had this sort of co-opetition relationship with Nvidia, so if they do start to eat their lunch, I can't wait to see the claws come out.
But Amazon wants to build its own AI chips, right? And eventually maybe not buy as many Nvidia chips. So it's interesting to see that kind of push and pull. And the other thing here, Maddie, that just fascinates me about this story is kind of the classic investor story of how a company grows as they give you a product, right? So Nvidia has built these very successful AI chips. Everyone wants them. How does Nvidia follow the customer through that journey, right? You think about Apple and iPhone, right? Apple gave us all of these great products. What did they eventually build out that's now one of the largest parts of their business, the services business, right? They continue to sell you things once you use the product and sort of go through that customer journey with you. NVIDIA's AI chips are a lot more complicated and a lot more B2B and a little bit different than that. But to me, I think it's a fair comparison to think about, okay, everyone bought our chips. How do we become a part of the next version of AI? We were talking earlier last hour about how there's sort of this shift from the infrastructure to what do we do with this? Cloud services is a huge, huge part of that next step. If Nvidia can actually eventually generate $150 billion in revenue off of this, then you start to talk about, okay, maybe AI chip demand isn't the entire part of the investor story, because I think for the large part of the last 18 months, it's been, well, what about when everyone has enough chips, right? And that's all the discussion's been. Maybe the discussion starts to shift a little bit if we continue to hear more about this on coming earnings calls.
And $150 billion, I believe AWS gets about $100 billion from its cloud business. So that would be them saying also, we think we're going to beat the biggest guy in the room here too, which is interesting moving forward. I just think it'll be fascinating to see. Nvidia, to your point, has kind of revolutionized itself multiple times already. They started as a video game chip maker. Now they're this AI giant. Will they also become a huge cloud player? They've got a lot of competition. So we'll see if they can pull it out.
They have a lot of competition in a lot of different spaces, right?
Yeah.
So if you have that chip competition that we've been talking about over the last couple of weeks, maybe your solution is to zag a little bit and have other sources of revenue that can also pick up. So certainly not a tomorrow story, I wouldn't say, but something that is important to track, especially if you're considering holding Nvidia over the long run, and the movement past that chip story into other sources of revenue could be rather attractive.
And especially if you're worried about that profit growth slowing moving forward, you got to look at where they will expand that. All right, Josh, thank you as always for joining me on set. Really appreciate you coming on here. Energy demand needed to power AI data centers is expected to explode past our current capacity by 2030. The industry is now turning to Bitcoin miners as a new power source. Crypto miner Core Scientific announced a partnership with Nvidia-backed CoreWeave to host its computers. That was earlier this year. And more recently, activist investor Starboard Value took a significant stake in crypto miner Riot Platforms with the intention of steering the company in a similar direction with AI. With Bitcoin now holding over that key $100,000 level, how will companies balance these two booming industries? We've got a great guest to talk about that question, Adam Sullivan. He is the CEO of Core Scientific. And Adam, it's great to speak with you about this because you yourself started really strong as a Bitcoin miner. Now you've transitioned towards a little bit more of a data center AI play with HPC, high performance computing customers. Where do you see yourselves now? How would you define your strategy today given the success of Bitcoin in recent months?
Yeah, I mean, it all really goes back to Core Scientific's roots. We were the largest Bitcoin mining company for the past 3 years. And that's really driven by the fact that we had to bring in traditional data center people to actually run the business. And so that's really been our differentiator. And so we think of ourselves as a digital infrastructure company, whether it's building data centers for Bitcoin mining or whether it's building data centers to host hundreds of megawatts of the GB200s that you guys were talking about earlier. You know, our core competency is driven through large-scale digital infrastructure.
So what do you anticipate the revenue split from AI customers to Bitcoin revenue looking like heading into 2025?
Yeah, for 2025, it's going to be a relatively equal split in terms of the two. But our expectation is to continue to grow the data center part of the business, which is just a radical shift from the high volatility Bitcoin mining space. Moving into the data center space, you know, these are long-term contracts that we're signing over 10 years, and it provides a lot of long-term and free cash flow stability that investors really enjoy. And as a CEO, I also enjoy that as well.
What kinds of clients are you looking at in that space?
You know, it's mainly looking at large hyperscalers or large enterprises. So those two customers are the people that are looking for these larger sites. So think 50 to 100 megawatt sites. And so that's what's driving the demand right now. The other part that's driving demand are a lot of smaller customers, you know, 10 to 20. But our focus right now is winning these large clients because that demand is so significant. And we expect that demand to continue into 2025. But these large scale sites that everyone likes to talk about, we think that is going to slow going into 2026, where you're not going to see hyperscalers, you're not going to see large enterprises necessarily looking for more large sites because they're going to have a number of these sites under development.
Absolutely. So given that a lot of these hyperscalers are investing in building up their own data centers, which ones are you going after?
Well, the thing is, even AWS, even Meta, even Microsoft, you know, historically, they've even used outsourced data center providers. So that's one of the largest drivers of demand for the large data center companies. Think Equinix, think Digital Realty. And so we're still approaching that market today. It's a very attractive market, obviously. These are large investment grade counterparties. And so that is our main target area for customers today. Over time, we're going to be looking at more multi-tenant, especially as you referenced inference earlier. Inference is going to be a major driver, think 2027, 2028, where we have a lot of smaller data centers located in major metropolitan areas to help allow for inference to actually occur.
Is that confirmation that you're talking to those three hyperscalers that you mentioned, Adam?
I would say we're talking to many of the hyperscalers that are out there and many large enterprises.
Okay, fair enough. Had to ask. So it's fascinating because you have all of this infrastructure, but it's expensive to transition that infrastructure over to a data center. Obviously, how hard is that pivot and how are you kind of allocating capital around that pivot?
Yeah, so for our existing contract, this is actually a contract where our customer is actually paying for the CapEx. You know, that really speaks to the demand for large scale sites today. And so as we look forward, we're deploying capital for a high performance computing center. So for every 100 megawatts, That's almost $1 billion in capital that needs to be spent in order to develop one of these sites. And so you just flashed a chart earlier, 15 gigawatts, looking at potentially 35 gigawatts of demand. That's something that is absolutely exceptionally expensive. That's over $100 billion in capital, looking more like $200 to $300 billion in capital that's being spent. And this is a lot of this is mainly driven by this GB200 shift, where traditional data centers are not equipped to host these new GPUs. And so that's why we're seeing all of this new data center growth, because it is a completely different form factor. We're looking at liquid cooled chips, something that hasn't been developed at scale in the past. And so looking forward, we expect to see more liquid cooled chips. And that's the reason why we're developing all of our infrastructure today for this newest generation of data center.
I want to end on policy. The incoming president-elect Donald Trump has talked about increasing energy efficiency and infrastructure to support the AI boom. I believe you've spoken with President-elect previously. What have your conversations about the outlook for energy infrastructure, specifically on policy, indicated to you about what the path forward under the Trump administration could look like for your business?
Yeah, the new administration is really forward thinking about firm generation power and how we can continue to develop new transmission lines to actually connect these large sites, these large generation sites, whether it's natural gas, whether it's nuclear, whether it's wind or solar. All of this is being developed outside of major metropolitan areas. And so we need new transmission lines. We need new firm generation power, think natural gas, think nuclear, to actually come onto our grid in order to support the long-term stability of the grid, not only for data center companies like us, but for all of the communities out there that need firm power in order to power their AC or heat or whatever it might be.
Yeah, certainly a lot of energy requirements amid that AI boom as well. Adam, thank you so much for joining us. Appreciate it.
Thank you so much for your time.
Coming up, we'll discuss the regulatory hurdles facing that Nissan Honda deal. Stick around for that next, right here on Catalysts. Japanese car maker Nissan confirming to Yahoo Finance it is discussing possibilities for future collaboration with Honda. Following reports, the two are planning to merge. A deal between the two, who were the fourth and fifth most bought auto brands in the U.S. during 2023, will create the world's third largest car maker. It could also draw regulatory scrutiny. So here to discuss that key part of the deal here, we've got Moselle Thompson, former FTC commissioner. Moselle, great to have you on here. Listen, the market is swinging with this merger coming to fruition here ahead of and after this news. How likely is it for this to actually happen?
Well, one of the challenges here is that we don't know exactly what it's going to look like yet. You know, there's been talk about a holding company. There's been talk about collaboration agreements on EVs, electric vehicles. So we don't know. But there's one thing that is true is that each country where these companies operate has an antitrust regulator, and they're going to look closely at how this affects their market, their local market. For example, in the U.S., Honda and Nissan both have manufacturing plants in the U.S. Honda is a very popular brand, has top 10 car sales in the U.S., and people are going to look to see how this is going to affect them. Now, to the extent that they want to try to focus on EV production, you know, EV uptake in the U.S. has been a little bit slower than other countries. So we'll have to see how that turns out.
Is that a more effective argument for these two firms in a place like China, where we have seen EV demand be so strong and really part of what's weighed on sales for both of these companies?
Well, one of the things that distinguishes the U.S. from, for example, Europe, where China's sales of EVs are going gangbusters, is that in the U.S., we have put limits on China's ability to sell in the United States. So we have Tesla as a major competitor, and you look at other companies, the U.S. companies, Ford, GM, they have gone in for EVs, but those EV sales have been slower, partly because they're more expensive, those cars, and second, because our infrastructure is not quite up to where it needs to be for as much of an adoption as we had hoped.
So more broadly then, I'm curious about the argument that you think would be most effective from Nissan and Honda here in terms of getting regulatory approval for a merger in the United States.
Well, I think what they would need to show is that Honda and Nissan, well, one of the things, Nissan is well publicized that they're in a little bit of financial trouble. Right. So one of the things they could be arguing is that Nissan has a troubled outlook and therefore needs some sort of merger in order to stay competitive in the marketplace. In other words, you would lose a competitor. That could be one of the arguments that they make. The other thing, too, is they'd have to show that if, to the extent that EVs are going to become a larger part of the American auto buying public market, that this will make them more competitive and make the anti-China growth bigger and better and stronger. Those are a couple of arguments that they could make.
So how much, as a former FTC commissioner yourself, how much does that actually weigh on the decision? You mentioned, for example, the fact that there is this challenging macro backdrop for automakers. If it's either merge or fail, does that make the merger more likely to go through?
Well, it's one of the factors that they could look at as a net positive. In other words, if there's going to be a loss of American jobs and competition within the marketplace, then that could be a positive speaking for a merger. But you'd have to weigh that against the fact that you'd have essentially a higher concentration within the market, especially for competitive gas-powered cars. And that's the thing in the U.S., because don't forget, Honda is very popular in the U.S., and Nissan, while it's not as popular, also sells some top 10 cars in the U.S.
All right, well, we got to leave it there, but thank you so much for joining us, Moselle. Appreciate it.
My pleasure.
Coming up, we're going even deeper into M&A with a look at how deal makers view the incoming administration, interest rates, and artificial intelligence. All of that next, right here on Catalysts. according to a new survey from KPMG, this year we saw just $1.8 trillion in total deals. That was below the pre-COVID average. But according to this new data, deal makers are optimistic about 2025. Joining me now in studio, we've got Carol Stryker, KPMG Head of Deal Advisory and Strategy. Carol, great to have you on set with us this morning. So talk to me about what this survey tells us about how deals are looking heading into the Trump administration. It feels like we're already starting to see huge M&A Mondays popping up, and he's not even in office yet. So I anticipate a lot of optimism.
Yeah, absolutely. As we look at the survey results and what we're seeing with our clients, a lot of optimism from the deal makers. We did a study, our annual survey just came out. We did it right after the election so that we'd be able to get that sentiment of about 300 deal makers, all with companies over $1 billion of sales. And the sentiment was just real positive, saying that they were looking at more deals than they were. 90% of them were looking at more deals than they were a year ago, 83% more than they were just 6 months ago. So real positive optimism coming into this new year.
And I'm fascinated about sort of the driving factors behind that optimism. And one thing that really stood out to me is that people are a little bit less obsessed with getting the highest possible value in the deal. It seems like, I felt like before companies were seeing Nvidia and then thinking, okay, well, I can get, trillions of dollars for my company. And I'm obviously exaggerating, but it seems like valuations are cooling as well.
Yeah, well, I think it's an alignment of the valuations, right? Like, I think that there were people who were thinking in the height of the valuations in 2021 that sellers were like, we're not going to sell unless we get that valuation. And so there was a misalignment, and we saw that even in the data that from the survey is that is still an impediment for doing deals, that misalignment of valuations, but it's come down significantly. And then what we're seeing also with the deals that we're working on is that we're coming together, more alignment around the valuation, which is an important part to obviously getting deals done.
So pricing is just more accurate now, it seems.
Yeah, and I think that there's an alignment in regards to sellers' expectations and buyers' willingness to pay the price that the sellers are looking at, so that just alignment of, interest rates are coming down, the cost of capital is lower, so I think that helps with the buyer's valuation as well. So I think that alignment of getting the prices to a place where they can actually transact.
Right. And it's interesting you bring up interest rates because we do have that key Fed meeting today, expected to cut, but the path forward for the Fed is a little bit more murky. If we do have a higher for longer environment, how much cold water does that throw on any of the optimism from this survey?
Yeah, absolutely. So, interest rates are a key element of doing deals and getting deals done. So if that, I think the cool water is more from a perspective if they start to go up. There's concern around inflationary things that might happen in the new administration. And so if that happens and interest rates go up, I think that's a lot more of the cold water threat that I would think of. I think in the current environment with interest rates, they've had 3/4 of a point cut this year so far. Today, like you said, is a big day to see if they're going to. Our economist is thinking it's going to come down 1/4 point. We're also still projecting that it's going to come down another 3/4 of a point next year. And so with interest rates being a key element of helping deals to be done, it is an important factor for the optimism that we're seeing. I think if it doesn't, and if it just stays flat, I think that we can still price deals, and there is a ton of other things that are working. I mean, when we look at the survey results, the number one issue is around growth. It's how do I help with the growth of my business, and M&A is a key component of helping that happen. And there is an enormous amount of dry powder. There's a lot of cash that needs to be put to work. So I think all of those aspects will help to continue to spur that M&A activity this next year.
Right, still nearly $7 trillion on the sidelines. You got to put that money to use at some point. Another fascinating part of the survey that I want to end with here is the number of deals that sort of utilize AI along the way, especially in private equity, just an overwhelming majority of deal makers utilizing AI throughout the process. How unique is that to you compared to previous survey results?
Yeah, so we definitely saw an increase around 50% last year talking about using AI and doing deals, and then up to 77% using AI and deals today. And the thing that I also found interesting is that it's throughout the deal process. So from the beginning stages of sourcing the deal to then transacting, doing integration, but also around the value creation. Actually, the value creation piece was within the survey where we saw it most. And then that's what we're seeing as well when we're working with our clients at KPMG, with our clients that are doing deals. AI is absolutely being utilized. And to your point, it is more being used within the private equity community than it is the corporates, but both are still using AI and seeing the value that it brings and helping them transact and doing smart deals. And then when they do the deals, creating value from those deals.
And increasing productivity along the way.
Absolutely.
It sounds like. Carol, thank you so much for joining us and bringing us this survey result. Really appreciate it. Thank you so much.
Thank you for having me.
Of course. Well, coming up, we are taking a look at opportunities in commercial real estate as the industry is still facing another year of headwinds. That's coming up next right here on Catalysts. Higher for longer interest rates and unprecedented levels of loan maturities among the few steep challenges ahead for commercial real estate. One sector still attractive thanks to persistent demand, and private credit is taking notice. Joining me now with more, we've got Greg Friedman, Peachtree Group's CEO. Greg, great to have you on. So hotels, the shining star of commercial real estate at the moment. What do you attribute that to?
Yeah, no, that's a great question, and thanks for having me on, Madison. Really, when you look at the hotel space today, unfortunately, it was impacted during pandemic, which really muted any new supply growth. And the hotel industry, just from a fundamental perspective, is benefiting from the fact that supply remains muted. Supply is growing at about a 40% reduction to historical averages, and demand is held up. It's been pretty resilient across the U.S. It's definitely been a little bit, less growth this year in demand, but we're continuing to see positive demand growth across the hotels that we own in our portfolio, across the hotels that we have debt positions on as well. They continue to do well due to that lack of new supply growth. And the other, factor that's benefiting hotels from an investment perspective is hotels trade at higher cap rates. And as you discussed at the beginning, rates are higher for longer. And so there's less repricing risk. There's less negative leverage. Just inherently, there's more cash flows coming off hotel assets compared to some of the other, commercial real estate assets.
Well, it's interesting in the context of what we've seen this week from Blackstone mulling the sale of one of their luxury properties in Maui. They've already sold a different hotel of theirs, another resort in Turtle Bay. What does that signal to you? Is that potentially a bearish signal?
Yeah, not necessarily. I mean, I think it's, people tend, different, developers, owners, private equity groups like us, we sell assets from time to time, and usually it may be driven by funds. It may be driven by, other issues or challenges or needs for that capital, or it just may be that they're getting great execution. I think, with it all being said right now, I think you're seeing a lot of assets trade across different property types. But transaction volumes are muted, and if you need liquidity, in a lot of cases, hotels, there's more liquidity in the market for hotels than some of the other property types where you can sell them at more premium pricing. And it very well could be that they're selling those assets because they're getting more liquidity back and getting better execution on the pricing side.
Switching gears a little bit, I want to talk about the office market. I like to look at this as an indicator of the return to office mandate and whether or not that's going to continue to be an option for folks to work flexibly. What are you seeing in terms of demand for CRE related to office space?
Yeah, I mean, it's rebounding. It's sort of interesting when you look across the office sector because, 90% of the vacancy really resides in 30% of the office buildings across the U.S. And vacancy right now is about there's about 1 billion square feet of, vacant space. So you are starting to see some of the office space, this vacant space or some of these vacant office buildings get converted into other use, which is helping, reduce some of that stress within the office sector. And, I think we're headed towards a bottoming across the office sector as we sit here right now.
So that bottoming, does that present an investable opportunity, especially for private credit moving forward?
Yeah, I mean, I think it's becoming, closer to being investable. We're not heavily invested in the office space. We do have some exposure to it. I think it's becoming somewhat interesting just because risk premium spreads, when you look at cap rates have elevated, risk premium spreads have elevated across the office sector. There's probably less repricing risk in general, just in that space. But it is starting to become interesting, and I think we're headed towards it being, more investable. And as you're seeing across the U.S., there is a return to the office. So that's taking place.
Really quickly here, Fed meeting today expected to cut by 25 basis points. The path forward a little murkier. How could a higher for longer environment impact CRE?
Yeah, I think it's going to make it very sluggish because I think, rates are going to, personally, I think rates are going to remain double. You look at long-term rates, the 10-year treasury rate, I think it's going to remain double from where it was pre-2022, that decade pre-2022. And that's going to put pressure on allowing values to rebound anywhere near what we saw from the pre-2022 levels, and cap rates are probably going to remain elevated across commercial real estate. So I think it's going to be somewhat sluggish across the equity side. I think it's going to make it more compelling to invest through private credit into commercial real estate. And that's our focus, just given the fact that you can go lend in a lot of cases, 60 to 70% of current values and get returns that are, probably, somewhat similar to the equity side.
All right, Greg, thanks so much. We appreciate it.
All right, thank you.
Coming up is Wealth, dedicated to your personal finance needs. Brad Smith will have you for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, the Fed is expected to cut rates by 25 basis points later today. What that decision and any further cuts mean for stocks in 2025, we'll discuss that with a portfolio manager. And a new report reveals financial advisors expect their holdings of exchange-traded funds, ETFs, to surpass mutual funds in the next 2 years. We'll dive in and talk about some ETF names that one strategist is recommending. Plus, how different generations should invest for retirement in 2025. We break it down for people in their 60s, 40s, and 20s. All that and much more coming up throughout today's show. But first, let's take a look at some of the market action here. We're 90 minutes into the start of the trading day. Boom, there you see it. The Dow's up, S&P 500, also fractional gains, and the NASDAQ Composite fractional gains. So edging higher today, going into that FOMC meeting, the Dow looking to avoid a 10th straight day of losses ahead of the Fed's interest rate decision. That's out 2 p.m. Eastern Time. Joining me now, we've got Ben Gutteridge, who is the Invesco portfolio manager for multi-asset strategies. And Ben, I mean, you ultimately see the Fed's path easing, continuing. So when do you see that shifting in 2025?
Well, I guess there would be regular intervals where the Federal Reserve would be reassessing the data, but you're still sort of looking at about 2 to 3 cuts next year, evenly spread. So that is the base case, and therefore I guess you're sort of talking about the end of the year before you get that sort of qualified pause where the Federal Reserve sort of says we're at or about the level of rates that can keep growth and inflation at trend and respectively at target. Of course, that's sort of a blue sky qualified opinion, but through the journey will no doubt be fraught with inflationary upside and downside surprises. But that's sort of the base case and the journey we're anticipating.
So what would then be the pass through to the equity markets, and what's your outlook there for 2025?
Well, the outlook for 2025 is a positive one on the basis that growth can remain resilient, that inflationary pressures, whilst not fading at the pace that most of us would want, still moderating, and therefore giving the Federal Reserve the flexibility to make a brace or 3 interest rate cuts. That type of mix is good for equities, but as I said, it's a pretty narrow path at the moment. Inflationary surprises could well lead to suggestions that the Fed is going to make a pause, or a couple of the central bank presidents, commentators could suggest, I'm thinking about a pause, and markets could be volatile in and around that base case. But the base case, interestingly, is one of about an 8 to 10% return. But of course, markets are so rarely sort of stable as that, and I think the risks are to the upside. You would either expect quite a big move or quite a pronounced down move. So base case sort of 8 to 10, but on balance, risks to the upside, I think, from there.
Now, what do you think are some of the sectors that are best positioned going into the mix of the equation that you just laid out?
Well, I think no matter the economic backdrop, or you can downplay the economic backdrop when it comes to the AI theme, the hyperscalers, the infrastructure that supports an AI rollout. Of course, valuations look even more giddy, but time and again, the market underappreciates the amount of growth that comes out of that sector. But of course, it is ever more perilous given valuations have moved in the direction that they have. And so a nice complement to that is something like financials. Again, resilient growth, nice for financials and banks' balance sheets. And net interest margins, interest rates staying higher for longer, a better story for the margins they're earning on that loan book. And with equity markets at in and around all-time highs, there's incentive there for companies to raise raise money on the stock market. And of course, that's good for some of the city banks, some of the more investment bank type names. So financials and that loosely defined technology sector, a nice blend, we think.
All right, Ben, thanks so much for taking the time here with us to kick off today's show. Certainly do appreciate it.
My pleasure.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, we've got Catalyst co-host Madison Mills. First up, nuclear power startup Oklo, that's up here after announcing an agreement with data center operator Switch to deploy 12 gigawatts of advanced nuclear power through 2044. According to the agreement here, Oklo will develop, construct, and operate these powerhouses to provide power to Switch across the U.S. through a series of power purchase agreements here. We're seeing the stock higher by about 1.8%. What do you think is at play here?
Well, it's fascinating, too, because they were up as much as 10% in the pre-market here. So huge swing to the upside. This is the latest signal of nuclear power and really any type of energy demand that can meet the demands required by AI and the energy use required by AI as a play heading into 2024 here. Switch is a provider of AI, cloud, and enterprise data centers. Meantime, you've got Oklo providing them with nuclear power. They say they want to hit 12 gigawatts of additional power provided to the grid through to 2024 here. This really emphasizes Oklo as an AI play in the space as well. And as a reminder, this is backed by the likes of Sam Altman. He is Oklo's chairman. So certainly part of their DNA is that they are an AI play. But you take a look at the stock here over the last month, seen some headwinds. We've seen kind of a slowdown more broadly in the AI space amid some headwinds and questions heading into 2024 here. But you take a look at news like this today and the deployment of these 12 gigawatts of Oklo power. I should correct myself. They're projecting those 12 gigawatts by 2044, which is a more realistic timeline to add 12 gigawatts to the grid. And that is part of what's powering the stock higher today.
Got to give yourself some cushion on these targets. Yes. Next up, let's talk a little electronics components maker Jabil, who is surging here today. We're tracking this one after beating analyst expectations for revenue and profit and boosting its guidance in this most recent quarter. Now, the company, which is a key supplier for Apple, is benefiting from a surge in data center infrastructure demand. Jabil's CEO citing strength in cloud and data center infrastructure as one of the drivers for its better than expected results here. Shares moving up by about 8.5%. Perhaps a few things for investors to cheer about here today, Maddie.
Certainly, especially because the stock has certainly not been an underperformer year to date. It's up about 14%. So just the latest catalyst to the upside for Jabil here. Their revenue coming in at $7 billion, a significant beat to the street estimate of $6.6 billion, as you point out, Brad. And as the CEO mentioned, the reason AI demand and cloud data center infrastructure, Jabil is one of those perfect picks and shovel plays in my mind as an example of what that can look like, because they manufacture these circuit brands that are utilized in AI products moving forward here. It's going to be interesting to see if we continue to see these picks and shovels outperforming, as we do anticipate further capex to be deployed in some of these AI names. I know we've been talking about that call from JP Morgan throughout the morning, the idea of more spend on AI, more AI moving forward here.
All right, you've been sitting here talking since 9 a.m. Get up off the desk. Come on, go back to your seat.
I'm thrilled to
Thanks so much for taking the time. Maddie, appreciate you sticking around, breaking down some of these trending tickers, and good breaking down some tickers with you on Morning Brief as well.
Thank you,
today.
Bradley. Thank you.
Switch gears here a little bit. Morningstar found a record 55 mutual funds were converted into ETFs this year. In 2025, Bank of America expects an additional $3 billion in conversions, and Cerulli Associates expects ETFs to hold more assets than mutual funds by 2026. For more, I want to bring in Todd Rosenbluth, who is the TMX VettaFi Head of Research for this week's ETF report, brought to you by Invesco QQQ. Todd, good to have you here in studio.
Great to be here.
Absolutely. Let's talk about this a little bit. We're capping off a record year of ETF inflows. What do you think has really driven that?
So you're right. So $1 trillion has gone into ETFs this year. We've seen demand for actively managed ETFs. We've seen demand for fixed income ETFs. We had the first ever crypto ETFs, Bitcoin ETFs that were quite popular. ETFs are increasingly where advisors and investors are investing, how they're investing. It's the way that their focus is. But you mentioned earlier a number of trends that are happening. Mutual fund to ETF conversions, mutual fund providers that are now launching ETFs in the space. That's a great area to focus on.
Why do you think that's happening?
Well, asset managers are going where the investors are, and we're hearing that advisors And we're seeing the data, but we're seeing that advisors, according to Verify, are increasingly turning to ETFs. So we have a firm like Neuberger Berman that has expanded its product lineup. They launched a new product today. They've rolled out a suite of products throughout the year. T. Rowe Price is another firm that's had success bringing some of their best and brightest into the ETF world from the mutual fund world. It's just exciting. This is where investors are focused. It's where the asset managers are focused too.
What can we extrapolate about the flows into ETFs this year to really give us a sense of animal spirits in the market right now?
Well, we're seeing optimism towards equities. We've seen greater bullishness. We at Verify hosted an event last week where we asked investors and advisors where they were leaning heading to 2025, and almost 75% were bullish on equities as opposed to bearish on equities. Now, we gave them two choices. The market's up roughly 30%. But we're seeing Vanguard 500, $100 billion alone has gone into that ETF. IVV, a second most popular ETF this year. We've seen core S&P 500 products, but you mentioned animal spirits. There's, of course, leveraged ETFs that are tied to single securities. We've seen options-based strategies. It's a great time in the ETF marketplace.
We talk about some of the most overcrowded trades right now in the market, and it has been long Mag 7 to this juncture that continues to hold strong and really outpace. But if you are an investor looking for the broadening to take effect into other sectors and areas of the market, what are the ways to play that from an ETF perspective?
So small caps is a great opportunity for investors to participate. And there's some actively managed products. I was mentioning Neuberger Berman earlier. They have a small and mid cap product, NBSM, that is new this year, again, bringing some of their best ideas. T. Rowe Price has a ticker TMSL, T-Missile, as I like to say out loud, in terms of saying tickers together. That has been gathering assets. We've seen actively managed small cap ETFs, small and mid cap ETFs start to gain traction. That's a great way to see the market broadening out.
Yeah, absolutely. Just lastly, while we have you here, and you're thinking about some of the generational approaches that we've seen over the course of this year and really flocking to ETFs, and what is anticipated as we get even more new market participants and investors coming on board. How is that anticipated to impact the ETF landscape furthermore?
So newer entrants into the ETF, new entrants being participants that are buying ETFs, they're likely to start with something simple and broadly diversified like the S&P 500, and then gravitate towards something that takes on, that can tilt to their portfolio. So we've seen some thematic-oriented ETFs. Global X has had success this year with some artificial intelligence ETFs, AIQ. We were talking about AI earlier in some of the leading stocks. That's a great way that we're seeing investors tilt their portfolio towards some of the growth parts of the marketplace.
Todd, great to see you. Thanks for joining us in studio.
Thank you.
Happy holidays.
You too.
Coming up, everyone, we're getting a pulse on the home market and looking ahead to the housing hotspots in 2025. That's next on Wealth. This time last year, Wall Street was hoping that the housing market would thaw in 2024. Instead, it remains stagnant. Here to explain why, we've got Yahoo Finance's Danny Romero. Hey, Danny.
Brad, the culprit here was mortgage rates. Data from Freddie Mac showed that in January, mortgage rates were hovering around 6.6%. Now rates are holding steady around the same level. So that means borrowing costs remain expensive. Buyers were also dealing with high home prices. The median existing home sales price jumped 5.7% on a yearly basis in February. Then, during the springtime, more house hunters were actively submitting loan applications, but that didn't increase sales. The reason? Mortgage rates were hovering near 7%, and that sidelined more buyers and sellers. Then, by the fall, mortgage rates fell to 6.2% as investors priced in interest rate cuts from the Fed starting in September. But sales didn't improve. More buyers and sellers were playing the waiting game, hoping that mortgage rates would continue to drop once the Fed began to cut. Now, once the Fed began to cut, mortgage rates started to move closer to 6.5% in October as market participants adjusted their expectations for future rate cuts. Now, as this year comes to a close, the rate path looks uncertain. The Fed will take center stage later today with the latest interest rate decision and, importantly, updating projections for its policy path in 2025. Now, bottom line, some housing experts expect housing activity to pick up next year as more homes will hit the market and with buyers and sellers adjusting to the reality of higher interest rates. Brad?
All right, Danny, thanks so much. Appreciate it. New home construction fell to a 4-month low in November. It's down 1.8% from the month prior, and this drop driven by a slump in multifamily projects. Still, new home inventory is currently at a 17-year high, and home builders are optimistic about the outlook from here. I spoke to Jim Tobin, who is the CEO of the National Association of Home Builders, yesterday. Here's what he had to say.
Get ready for what I think is going to be a golden age of housing production over the next 4 or 5 years. We really need to get those pieces of land in the pipeline now, and we need to get them in there affordably so that we can meet demand in the future.
So what could take us into that golden age of housing? We have Lawrence Yun, who is the chief economist over at the National Association of Realtors. Lawrence, always a pleasure to grab some time with you here. Let's just start there. What are some of the driving forces or factors that would play into any golden age in housing?
Well, good morning, Brad. Certainly, the home sales have been rising recent months after being stagnant in the early part of the year. And the reasoning is very simple. We have more inventory. So more inventory is bringing out more buyers. We know that the mortgage rate is not fully behaving as the Federal Reserve has been cutting rates, mortgage rates stubbornly refusing to decline. But the more inventory, more choices for consumers are bringing buyers back into the market. That's why it is critical that the builders ramp up production in the upcoming years. So I do believe that the builders need to produce more and will produce more, thereby providing that golden years upcoming.
And so as we see the waning impact of election uncertainty, how do you anticipate that will be passed through to the purchasing activity in the housing market in 2025?
Very good question, because all the past election data shows, independent of which party wins the White House, that post-election, there is slight bump in home sales. I think this is just a natural phenomenon of people essentially being unglued from television and getting back to the real life. Furthermore, that there is certain certainty. People know, for better or worse, what the policy will likely to be under the new administration, and therefore people are more confident about making the major purchase, like home purchase, and therefore I anticipate that little additional bump post-election.
As I was taking a look at some Redfin data, and I know NAR, you've got your own excellent data that you read through, but one of the headlines that Redfin had this morning was talking about existing home sales rising to the highest level in over a year and a half. And some of that was tied to factors that we just mentioned a moment ago. But what else do you think needs to play out in order for this to be broader momentum for existing home sales?
When you look at all the corporate data, like for example, home sales coming out of Remax, home sales data coming out of Coldwell Banker, and other information is clearly indicating that the market is seeing some momentum. I think the continuing job creation is certainly a help. The mortgage rate, even though it's not declining, the stable mortgage rate, and let's remember, under 7% mortgage rate is below long-term historical average. 50-year mortgage rate average was roughly 7%. And we know that people who purchase home in the past years at 10% mortgage rate, 8% mortgage rate, whatever it was, they build wealth over time. And I think Americans recognize the potential. They want to get into the market if inventory shows up. So now that the inventories are beginning to show up, we are seeing good data coming out of Keller Williams and other brokerage companies that shows solid momentum building up.
I want to get to the National Association of Realtors 2025 housing hotspots here. You've listed 10, including Boston, Massachusetts, Hartford, Connecticut, Grand Rapids, Michigan, Phoenix, Arizona, among the top of that list here. And I'm actually proud to say that as of this year, I've been to all of these cities. So I can say something or another about each of these housing markets. But why do you expect these cities to be hotspots next year?
We were looking at some of the net migration trend. Is the job creation a little faster compared to nearby neighboring metro markets? Other factor is whether or not inventories are showing up, and the millennial generation who have deferred home purchase, likely due to the housing affordability challenges. Well, high-income millennials, where are they going into? Where there is a pent-up demand? And also we are looking at the home sellers who have been sitting in their home for many, many years. We know there are life-changing circumstances, and generally Americans would move in 8, 9, 10-year time period. So if a locality has many homeowners beyond that tenure, it's certainly implying some pent-up seller, more inventory expected to come onto the market. So that's how we made those selections related to top 10. But I will say, majority of the U.S. markets, aside from the top 10, I think they will see a measurable improvement in 2025.
And at what price? How is affordability anticipated to fluctuate from your outlook?
The affordability will improve. The Federal Reserve will likely cut interest rate today and possibly more so next year. Mortgage rate has not yet responded, but it's just inevitable. With the banking lending rate being so low, mortgage rate will tilt downward, so that will help affordability. Income increases a little faster than home price growth. That will help affordability and also more supply, certainly giving more options to the buyer. Buyers would have better negotiating power to get into the market.
How many rate cuts do you anticipate we would need to see in order for there to be a real dent and an improvement in affordability next year?
The Federal Reserve likely will make about 4 rounds of rate cut next year. But I think the key factor for the mortgage rate is really the 10-year Treasury yield. And that will be impacted about how we address the future budget deficit. So if somehow the budget deficit projection is manageable rather than getting out of control, that will meaningfully bring down the mortgage rates.
Lawrence Yun, great to catch some time with you. Thanks so much for joining us here on Yahoo Finance.
Thank you.
Coming up, everyone, your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We're 2 hours into the trading day and it's time for Yahoo Finance's Market Minute. Stocks mostly higher ahead of the Fed's final rate decision of the year out at 2 p.m. Eastern. Here are 3 trending headlines that we're watching today. Elon Musk makes history as the first CEO with a net worth of $500 billion. Tesla's post-election rally pushed the stock up more than 90% year to date, with most analysts predicting more upside ahead with looser regulations for driverless cars. Plus, Netflix is being fined $4.8 million by Dutch regulators for allegedly mishandling consumer data. A recent US labor ruling classifying some of its reality show cast members as employees, adding pressure on the stock. Plus, Merck's new licensing deal for an experimental oral weight loss drug from Chinese drug maker Hansoh is worth up to $2 billion. Rival Viking Pharmaceuticals tumbled on the news, especially as Merck was eyed as a potential acquirer of Viking. And that's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
It doesn't matter if you're retiring in 3 years or 30. There's plenty that you can do in 2025 to keep building that nest egg. Here to help us with the retirement top tips for different generations, we've got Anthony Saccaro, who is the Providence Financial and Insurance Services President. Anthony, great to have you back on the program with us. I want to start with the closest to retirement, 60-year-olds. What can these folks do in their final working years to keep saving?
Well, I think when you're in your 60s and you have a decade or less to retirement, you really need to start focusing on shifting to more conservative investments. And I like to focus on investments that are going to pay interest and dividends, because you can count on interest and dividends you can't count on growth. You have no idea what is going to happen with a growth-oriented portfolio, but you can count on interest and dividends. The challenge here is that we've had a good decade and a half, and now we've had a good couple of years in the stock market, and the next couple of years may not be the same. The next decade may not be the same. And if the market crashes at some point in time, is likely to happen, if it crashes at the wrong time, you might not be able to retire. And we just don't want that to happen. So if you're in your 60s, you need to start shoring up your portfolio, making it a little more conservative, start focusing on interest and dividends. It's not so much about growth anymore as much as it is about protection.
And so with that in mind, let's talk about those who are in their 40s, those future retirees, but a little bit longer ways off than the 60-year-olds.
So when you're in your 40s, you still probably have 20 years to go. There's a couple of things that you need to be thinking about. First of all, dollar cost averaging should absolutely be a part of the equation. That's just where you're investing the same money over and over again into stocks or into mutual funds. And you want to be focusing on a combination of Roth IRAs and traditional IRAs. When you put money into a Roth IRA, you're paying tax on the seed, and that harvest is going to be tax-free forever. And it doesn't mean you have to contribute everything to a Roth IRA, but the clients that I have and the people that I talk to in retirement that are the happiest are people that have a balanced bucket of tax-free money in Roth IRAs and money that they have in pre-tax or traditional IRAs. And by focusing on traditional IRAs and Roth IRAs at the same time and creating that balance, you're going to give yourself a lot of flexibility in the future, but you're going to get some tax breaks now as well, too. Keep dollar cost averaging. Do everything you can to max out your 401k in your 40s. You should be able to do that. You put in your $30,500 a year, and you're going to wind up with a good bucket of money down the road. Maximize your savings for sure.
And finally, let's talk about Gen Z, those in their 20s.
So when you're in your 20s, you want to start the habit of saving. Dollar cost averaging, as I mentioned, start saving something. 10% is a good number. It doesn't mean that's where you want to be the rest of your life. You could move it up to 15 or 20% down the road, but 10% is a good number to start saving. So you want to focus on the habit of saving. If you were to make $20 an hour at 8% a year average over time for 40 years, and you just save 10% of that, it'll grow to $1.2 million over 40 years just by saving 10%. So get in that habit. Again, Roth IRAs, if you're younger, you're making $20, $25 an hour, you're not in a high tax bracket at this point. Almost everything you should be doing should be in Roth IRAs because you're not going to get a huge tax savings anyway, but you're going to have a huge tax savings down the road. And home ownership, you're in your 20s, start focusing on saving some money, not just for retirement, but figure out a way to save some money for home ownership with the idea of having that home paid off in retirement. You'll be really glad that you did that. In retirement, you won't have any rent, and you'll own your own home. So a couple things to think about in your 20s.
Just lastly, Anthony, while we have you here, I was looking at an Allianz Life study and survey just before we came on air here and talking about more Americans planning to focus on finances in 2025. They found that for the amount of people who are looking to improve their finances, 15% looking to pay down credit cards to do so, but 15% also saying that they're increasing their retirement savings, and that's what they're laser focused on. What is the number one retirement savings New Year's resolution that people should be keeping in mind?
Well, the order of events should be to save yourself $1,000 in an emergency fund. And we're talking about the younger generation that doesn't have any money at this point. Number one, get yourself $1,000 in the bank. There's a psychological effect for having money set aside that you just know is there for emergencies. You want that psychological effect to start building in. Number two, get out of debt. I would rather see you focus your income and focus your payments to get out of debt as opposed to saving. If it's a matter of putting more money in your 401k or paying down your savings, pay down your debt rather. Pay down your debt first and then start saving in your 401k. Once you've got an emergency fund, small emergency fund just for the mentality of it, once you have your credit cards and your debt paid off, then you can start saving 10% a year. That would be the three top priorities in that order.
All right, Anthony, it looks like you're about to bless up a couple team members over there with all them gift bags behind you here. Hope you have a happy holiday season.
Happy holidays, Brad.
We're closing in on the end of the year, and if you're getting bombarded by messages to donate to charity, guess what? You're not the only one. And if you're over the age of 70 and a half, there's a special way that you can donate to benefit someone in need. Here with more, we've got Bob Powell, who is the editor and publisher of Retirement Daily and host of the Yahoo Finance podcast, Decoding Retirement. Bob, great to have you here on set with us. Let's talk about this. What is the donation method?
Sure. It's called the Qualified Charitable Distribution. And for folks who are 70 and a half, they can contribute directly to a charity up to $105,000. And if you're a married couple, you can make $210,000 donation to a charity. A couple things to keep in mind. The IRA trustee has to make the contribution directly to the charity. And the good news is that this won't count toward your taxable income. So it's a great way to sort of like do good with money that you might have or typically donated to charity.
Yeah.
But instead of having to have that count toward income, it doesn't. So it's a great way to do that. One other thing, if you're age 73 or older and you're taking required minimum distributions from your IRA, you can use that qualified charitable distribution QCD to satisfy your required minimum distribution. So it's a great way to sort of like take care of your finances and take care of your charity.
I'm not going to lie, Bob. I'm trying to figure out, and it seems like a lot of our team is too, why the half? Why 70 and a half? Seems like we could have just rounded down to 70 or rounded up to 71.
Oh, you're asking the unanswerable, Brad. Like, no one knows.
We're splitting hairs here. Okay, a better question. We also have the Secure 2.0 provisions that are taking effect in 2025. Secure 2.0 is a federal law that encourages Americans to save for retirement. Bob, what are some of the provisions that you're closely watching?
Yeah, so there were 92 provisions that were put in place in Secure Act 2.0. Many of them are coming into play in 2025. The one that I really love is called the super catch-up contribution. So if you're contributing to a 401k, a 457, a 403b, or a thrift savings plan at work, you can typically contribute $23,500 to it. If you're age 50 and older, you can contribute an additional $7,500 called a catch-up contribution. But if you're 60, 61, 62, or 63, you can contribute an additional $11,250, which means that the total amount that you can set aside in your 401k is now $34,750. Not a bad deal.
Yeah, not at all. Bob, thanks so much for breaking this down for us.
Yeah, you're welcome, Brad.
You can catch more of Bob on Decoding Retirement. That's Tuesdays, 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. As we head into the last 2 weeks of the year, we want to look at some of the money moves that you still have time to make. Here with more, let's bring in Jason Bottenfeld, who is the Stewart Partners Global Advisory Partner and Managing Director. Jason, good to have you here on the program with us. You have 4 key money moves for year end, and the first have to do with equities. So what do people need to know?
Yeah, thanks for having me, Brad. It's an interesting part of the year at the end of the year here when people are thinking about what do I do with my portfolios, and depending on what you've invested in, they could be extremely high and your allocations could be a little bit out of whack. So when I talk about that, is more of, you should have a strategic allocation. You had a lot of guests on earlier talking about putting money into IRA accounts and taxable accounts, but what is that allocation that you have in there, and is it skewed, and has it been skewed? And this is a good time at the end of the year to take a look at that and say, should I be rebalancing back to that versus letting it continue to ride, which is has been a good strategy over the last few years, but you need to really pull back and take a little risk off and go strategic with your allocation, get back to that strategic allocation.
You also talk about what to do with taxable accounts. What should people know there?
Yeah, again, at the end of the year, you don't want to do anything that's going to cause a lot of additional taxes if you haven't already. But one of the things to look at is that potentially in portfolios, because of what's going on with interest rates and the Fed, that the bond market really hasn't kind of bounced back yet. So you could potentially still have some losses in there, or if you made some allocations there this year, they could be down 1 or 2%, and it could be an area to where you could take a little bit of that loss and offset any harvesting of gains that you did during the year, or you might do towards the end of the year as you rebalance back to that strategic allocation. So you want to be mindful of what you're doing here at the end of the year. You've only got a few weeks left. You don't want to create a huge tax burden if you don't have to. But again, rebalancing back to that strategic allocation makes a lot of sense.
How about your IRA or your 401k? What actions need to be taken before the end of the year?
Yeah, so that's where I kind of make a little bit of a shift from what I just said, which is, you could be a little bit more tactical inside of those, because as you're making these moves and you can make a little bit broader cuts. And by saying that, what I mean is try to find some, positions that are outsized. I mean, even a 7% allocation in some tech stocks could be weighted to 10% now. And if that's not where you wanted to be, again, rebalancing back. But making some broader cuts and taking maybe about 10% out of equities, parking it into an area to where if we go into next year, just to see what happens, there's going to be a lot of things that happen within the Fed. We've got a big decision coming today. You know, there's things that can happen. The front part of the year can really tell you the direction of the rest of the year for next year. So it gives you a little bit of time to be tactical, but in IRAs and 401ks, you don't have a taxable event when you do that. So it gives you an area to lighten up a little bit of risk if you're over your bounds.
You know, it's interesting as we've continued to hear some of the outlooks for 2025 come from many major institutions and wealth managers. They're also looking beyond the U.S. They're looking internationally here. I wonder how you're assessing the environment and where there are opportunities internationally versus domestically as well.
Yeah, I mean, domestically, I think our year-end holiday rally is going to keep going. I think, one of the themes that I've always talked about, and I get a little bit of pushback from the larger firms and things of that nature, is on international investments. I mean, I really feel like that there's been a huge value trap there, and honestly, there's been underperformance in that area of investing in developed or emerging markets. You can do some outsized returns in there in the emerging markets, but over the last 3 decades, I mean, you've seen $100,000 that could be 1.2 million if you invested in the S&P 500, only equated to about 400,000 if you're invested in developing international. So, and that's over 3 decades. But even the last 4 years, you've seen underperformance to those same levels. So I really find that, investing internationally, there's an old adage that if the U.S. sneezes, the rest of the world's getting a cold. So if we have any kind of hiccups, I'd have to imagine that the rest of the other countries are going to have hiccups too. So I like to keep the money here domestically. Internationally is just not a play that I'm interested in right now.
Yeah, it's interesting. I was looking at some of the assets that were being reviewed by BlackRock as well within their own kind of assessment of where emerging market equities are performing and even into European equities and so forth versus the 2024 range here, and still kind of at the far right side of the target, if you will, but not quite exactly to where it measured up at the higher end of their range, if you will. So going out into next year, what would need to take place in especially the geopolitical environment where we're going to be looking at potentially a tit-for-tat tariff talk or tough talk or conversations that initiate? What do you suspect might be the pass-through trade as a result of any tariff talk?
Well, I mean, that kind of brings into the macro strategy of if tariffs spike up the embedded embers of inflation. And so if tariffs really come into place and we start to see that there is some struggles, internationally with, as far as product coming in, but also if, that could put a lot of weight on the U.S. markets and we could see inflation. And if inflation spikes up, I'm not sure it's going to matter where you're investing, but I think that's kind of that's the big thing that I was hoping was going to be taken off the table in 24 that's going to keep translating into 25 is just this inflation picture. I was hoping for it to be done, but it's staying there. It's sticky. And so I think that's where my mind is opposed to anything else outside of any kind of X factors that might happen geopolitically or across other countries.
Yeah, and the largest contributor seems like in housing and shelter that it's not going to abate, at least in this near term. A lot of very low interest rates, very low mortgage rates out there that people are still sitting on right now. Jason, thanks so much for taking the time with us.
Thanks for having me, Brad.
Certainly. Let's get a check of the markets ahead of the Fed rate decision. 2 p.m. Eastern time is when that is going to drop, and then we're going to get some commentary at 2:30 p.m. with the press conference. Of course, Yahoo Finance has you covered going into, during, and after. But some of the market activity going into that meeting, as we're just outside of 2 hours away from the decision here, we are taking a look at the Dow Jones Industrial Average. It's up by about 0.3%, looking to snap its longest losing streak here that we've seen since the late 1970s. And so taking a look at the Dow Jones Industrial Average, and there you're taking a look at some of those components here. One of the biggest decliners on the day as of right now is Honeywell. That's down by about 0.8%. But then taking a look at the biggest gainer here on the day, oh my goodness, take a look at Nvidia. It's up by about 3% right now. And of course, year to date, holding on to some hefty gains. Solid mention, Nvidia and Blackwell was Yahoo Finance's product of the year. You can see more of a deep dive on the Yahoo Finance platform for that one. That's a look at the Dow 30 components, and then just quickly we'll ride out with a look at the NASDAQ 100 as well, where you get some of your mega cap tech stocks, some fractional declines for Microsoft and Amazon here on the day. Apple flat, just barely to the downside right now. Coming up, 2024 was the year of Nvidia. We're taking a look at how the company took the world by storm and some of the competition shaping up in 2025. A programming note. On today's episode of Living Not So Fabulously, Education Director and Advocate Cam Lieberson joined to address teacher salaries both in public schools and private schools. Important topic, take a listen.
A lot of times in education, what I felt like was happening was it was all about the people in charge and if they felt like teachers were worth paying. In public schools, it's very much like there's a union and the union has, salary steps, and that's what you get paid based on your experience, based on your degrees. Mm-hmm. Whereas in the private sector, it's more about what the school's budget says. Mm-hmm. And I'm now in a position where I'm a preschool director. And so I set the salaries for the teachers. And so it was really important to me immediately when I came in. I said there wasn't a salary scale. People were just kind of like getting small raises based on whatever they asked for when they were hired. And there were a lot of salary discrepancies amongst the teachers.
And you can catch more of Living Not So Fabulously every Wednesday at 12 p.m. Eastern on Yahoo Finance or wherever you get your podcasts. It's time now for our tech support, our weekly look at the world of phones, computers, games, and all things technology. No company was more synonymous with tech this year than Nvidia. Its stock is up around 170% so far over the past 52 weeks, and Yahoo Finance awarded its Blackwell chip the product of the year. So here to recap Nvidia's banner 2024 and give a preview of what to expect in 2025 is Yahoo Finance's own Dan Howley. So Dan, how did Nvidia take over the world again this year?
Yeah, I mean, it really is kind of the same story just repeated as 2023. They're the company that has all the hardware, all the software that everybody wants. And so, the way that Nvidia got big was they started investing early in AI when everybody thought that CEO Jensen Huang was, just a madman for doing that. They were trying to shop around ways to make the AI kind of capabilities work. And then generative AI came around and they started just kind of riding that wave. Along that, they had built their CUDA software so that they could unlock the graphics card capabilities to run other programs. And so that's gone hand in hand with the hardware. And now developers like to use the CUDA software, or they've already built their applications on the CUDA software. And so moving over to a different kind of platform would be too much. And so they're sticking with it. And they've managed to keep doing that and keep improving. Now, for 2024, I think the big deal has been the Blackwell chip. They announced that at their GTC conference earlier this year. That's been the thing that everybody has been piling money into Nvidia over, just because they know that it's where all these hyperscalers, the Microsofts, the Googles, the Amazons, the Metas, the Teslas are all going to go ahead and purchase to ensure that they have the best capabilities for their AI models, whether that's training, which is the hard part, or inferencing, which is less intensive. They've just managed to hold on to this place. They own anywhere, I think the estimates are between 80% and 95% of market share. There's competitors out there, but they're just not breaking through. And so because of that, Nvidia has managed to completely dominate 2024 again. Now, okay, what does that mean going forward, right? There's AMD, there's Intel.
Yep.
What does that mean for them? Well, not too much. AMD is getting into the space. They're there already. They have their MI300X, which, by the way, I just saw on eBay this morning. I was talking to Maddie about this, and I just found one on eBay. And the Intel side is about how they can try to get into this space on the GPU end. Now, they haven't been able to really do that yet. They're not gaining market share. In fact, AMD is taking market share from Intel on the CPU side of things. So the competition is absolutely there in that respect. The bigger problem, though, is their own customers. That's the Amazons, the Microsofts, the Googles. They're building chips now that can compete with what NVIDIA has to offer. The big thing is on inferencing. So training is where you tell a model, you make a model, right? You tell the model, this is what you're going to do.
Right.
The inferencing side is where you go and run that model so that it gives you, ChatGPT is telling you, who Juan Soto is and why the Mets are going to be amazing this year. Let's just see, okay? Just give me that.
Exactly.
Still, it's December. But that's where these other chips can benefit because they may not necessarily be as powerful as NVIDIA's, but they'll be able to do the inferencing potentially for less money.
I need you to drop me that eBay link. We're going to check it out after the show.
Yeah.
Dan, thanks so much for this week's tech support. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up 3 p.m. Eastern Time. They'll count you down to and through the market close.